Hola, buenos días a todos. Bueno, pues es un gusto para mí dar la bienvenida a estas mesas de diálogo que hemos preparado en conjunto el Centro de Investigación y Docencia Económicas, la Facultad Latinoamericana de Ciencias Sociales e IDEAS. Bueno, pues sin más preámbulo, yo voy a dar la palabra a la doctora Noemy Levy, que nos va a apoyar con la moderación de nuestra primer mesa en estas mesas de diálogo tituladas Economic Recovery After COVID. Welcome, everyone.
Gracias. Debido a que tenemos invitados extranjeros que no hablan nuestro idioma, me voy a permitir hablar en un inglés que espero sea comprensible. Since we have foreign guests, we will try to speak in a common language in order to understand ourselves. I hope they will understand my English. First of all, I think we need to thank CIDE for organizing or hosting the seminar Economic Recovery After COVID. I think it's very important, very meaningful for two reasons. The first, we have representatives of the Organization of Ideas, International Developed Economics Association, that have pushed programs towards a better and obviously a different world. Fight against inequality in all forms, income, gender, race, employment, sanitary, and a long so forth list, including political repression and the issue of environment deprivation led by rent-seeking capitalists. I think this is one of the main characteristics of IDEA. The organization of ideas for many economists have been an alternative space of discussion when neoliberals close their space to alternative economic thought. I still remember the huge seminars held in 2000 all over the world that we were able to discuss what was going on and set alternative programs. This was very important for us. In addition, and the second reason I think this meeting or this seminar is very important, is that I want to announce that IDEAS has set its branch in Latin America and the Caribbean. I would regard this as the first meeting of IDEAS LAC. We should call it like this to set aside some other names that we don't like, which I'm honored to preside. I just want to take the opportunity to say that the work of ideas in Latin America and the Caribbean can be very important and can be very meaningful today. It's not an easy time for us. It's not an easy time for the world. We hope that we will go a bit more to other ideas, Argentina, Chile. We hope Colombia, Brazil can be a difference in what is the development of Latin America in this world. In this context, today's discussion is of utmost importance. The dominant economic model is under a huge economic and ideological strength since 2008 global financial crisis and the present stagflation, in the light of which we are debating where to go and how to shape the future. I must admit that we are in a very delicate moment, similar to the 1930s, and the options are popular governments under totalitarian regime resembling European fascism, which is very scary, or a big capital political arrangement that aimed to reduce inequalities, set better life conditions for the poor, and limit the interest of capital. Let me finish saying that today these challenges are of utmost importance in Latin America because of the political arena that the region is in. In this context, let me first present let me present the first speaker, Jayati Ghosh. How can developing countries cope with 2022 perfect storms of global inflation, climate change, and financial volatility and livelihood crisis? I think the presentation names is a lot of insight to what we need. Let me only present our guest, very small words. Jayati Ghosh taught economics at the Jawaharlal Nehru University, New Delhi for nearly 35 years, you told me yesterday. And since January 21, she is a professor of economics at the University of Massachusetts at Amherst. She obtained her PhD at Cambridge University. She has authored about 20 books, 200 scholarly articles, and she was Executive Secretary International Economics Ideas, Associate Ideas, and from 2021, she also has experience in consulting at state level in India and international organizations, including ILO, UNDP, UNCTAD, UN Department of Economic and Social Affairs, United Research Institute for Social Development, and Women. And she's a member of several other boards and commissions. I wouldn't go on because I wouldn't finish. And I think it will take me long that her presentation. So without much, please, Jayati, take the microphone.
Thank you so much. And it's a great pleasure to be here. And it is very thrilling to be present at the launch of Ideas LAC. I'm really hoping that this is the start of many, many wonderful events and collaboration across the Global South. So thank you so much to CIDE and to Professor Romero for inviting us and enabling us to share some of our views. So let me begin by just very briefly outlining the problems. It's repetitive. I think all of us know how terrible the world is and how difficult the situation is for developing countries. Nonetheless, it's, I think, useful to just highlight some of the context in which middle income and low income countries today have to negotiate what are increasingly uncertain waters, really. So we know, or we should know, except that the media increasingly try to present it differently, that the global economy was already decelerating and not in good shape before the pandemic. It's presented today as if it's the pandemic that came and created this big tsunami of disaster and that, otherwise everything was fine. It wasn't. We had significant deceleration. The recovery did not have the same level of employment generation that was expected. And basically, global capitalism required huge transfusions of liquidity on a daily basis just to keep afloat. So the monetary policy reaction after the global financial crisis was one that required massive liquidity inflows of unprecedented historical dimensions just to keep business as usual going along. And of course, this was also associated with massive increases in inequality. We thought those were, again, historically unprecedented levels of inequality before the crisis. And now we know that you can get even more unequal because that's what the pandemic did, is to create even more inequality globally. The other thing that was marked even before the pandemic is that we had many new forms of imperialism emerging. Now, let me explain what I mean by imperialism. For me, I see it as the struggle of large capital for different types of economic territory supported by their states. Okay, so economic territory varies. Of course, it obviously covers land, different kinds of natural resources, labor, and markets, access to markets. These are traditionally what was seen as the types of economic territory that large capital struggled over. But we also have new forms. We have intellectual property, a new thing, relatively speaking, or really knowledge, access to knowledge and the use of knowledge as critical forms of economic territory that have been used now to extract monopoly rents and which have become an increasing impediment to possibilities of autonomous development in most of the world. We have cyberspace, which has emerged again as a new form, the digital realm, if you like, which is a very important economic territory, which is partly related to knowledge, but not only, and which has become a very important lever for determining other economic processes. We have finance and the global ability of cross-border finance, not only to determine and impact economies' movements, but also to affect the policies of governments, so that the fear of capital flight can determine whether or not you will run deficits. The fear of capital flowing or the desire to attract capital determines a whole range of other economic policies, so that the World Economic Forum has probably become a greater determinant of countries' policies than the old devils, shall we say, the Washington Consensus Group, the international financial institutions, simply because of the power of global finance. And we have the need to control new natural resources, for example, lithium, which all of you in Latin America know a lot about, and the rare earths, which are increasingly important for the green energy transition, for the requirement for electrification globally. And we have, related to that, control over emissions, or rather, who will get or who will be able to grab the global carbon budget. I would just remind you that 14% of the world's population in the advanced countries have been responsible for 85% of global carbon emissions historically. And even on the basis of the current COP26 commitments in Glasgow, they would continue to be responsible for 60% of carbon emissions globally. So that is the broader context within which, in fact, you then had the COVID-19 pandemic. And of course, this pandemic, as we said, was associated with massive increases in inequality. There are the more obvious forms of inequality, like the vaccine inequality, the vaccine grabs, and then the control of patents of the large pharma companies, which have prevented much wider production and distribution in the rest of the world. But there was the fiscal inequality, the huge inequality in fiscal response. So developed countries, which had earlier been saying you can't do fiscal policy, suddenly discovered that you could, that you can take money out of a hat, which in fact you can, and advanced economies in particular can, and they did so. So we had 11 trillion in terms of fiscal impetus, fiscal stimulus provisions from January 2020 to March 2021. And 90% of that came from, once again, this very small group of countries. 90% of this 11 trillion was spent by advanced economies. That too, a small number. 10 economies really covered that. The US alone accounted for 55%, more than half of the global fiscal expansion. The rest of us, 86% of global population, we are scrambling to put together anything. And in fact, the low and middle income countries spent less than they had after the global financial crisis. And where in terms of GDP, for sure, in per capita terms, pathetic. To give you just some idea of what this translates to in absolute amounts, in that period I'm talking about, January 2020 to March 2021, the US had spent approximately $26,000 per capita additional spending. Okay, the low income countries had spent $2 per capita. That's the kind of difference in fiscal response. Remember also that the low and middle income countries have dominantly informal labor markets. 70% of workers in low and middle income countries are informal. That is, they don't automatically get any legal or social protection. They don't even get medical coverage during a health crisis and so on, because the employment relations do not cover that. So they were more in need of fiscal measures to cover social protection, and yet they were able to spend much less of it for the reasons I have outlined, and because the other point I did not mention, the developing countries already had a significant overhang of debt. Not all, but a very large proportion of developing countries had significant external debt issues, which limited their ability to actually engage in massive stimulus efforts. So all this, in fact, meant that developing countries were already in a much weaker position, let us say by the end of 2021, because they had simply not been able to spend to the same extent to bring the economy out of the pandemic-induced crisis. We all know what the pandemic did. I'm not going to, and is continuing to do, right, in terms of closures, of a stoppage of economic activity, lockdowns that brought about, in my country, in India, very brutal impact in terms of the livelihood of informal workers. In India, they are 95% of all workers. And we all know what it meant for women in particular, in terms of being the first to be out of the workforce and also much greater increases in unpaid work because of the greater demands of care. All of these were the internal impacts, but I'm talking now much more in terms of the global impacts, the global inequality impacts. Since early 2021, what have we seen? We have seen the new tsunamis. Everybody blames the Ukraine war for the food and fuel price increase. And yes, that was the catalyst for the major. I mean, they had started going up slightly before then, especially because of US expansion and so on. But broadly, everyone blames the war as the big reason for food and fuel price increases. I would argue that that explains less than half of the increase that we have seen. The rest of it can actually be explained by profiteering by the major oil companies and by the major food distribution companies, the ABCDs of the food distribution network and the major oil companies. This is now beyond evident, not only in terms of the work done in the United States, which shows that profit increases account for 80% of the price increases in the last 3 months, but also in terms of just the quarterly reports of these big pharma, food and fuel companies, which have all shown historically highest levels of profits in the first quarter of 2022. Dramatic increases in profitability driven by the price increases. So when we talk about it, let's not blame the war and the supply shortages alone. It's really also the fact that companies have been able to profit from this, partly through massive and direct increases in their own prices, and partly through financial activity in the futures markets and commodity futures markets, which have driven up the futures prices and then had an impact also on the spot prices. So, for example, some studies show that in France and Germany, 72% of the activity in commodity futures in March was by finance companies, by mutual funds, by pension funds, by a range of financial companies that were interested only in the financial returns from these essential assets. So that's really one of the reasons why all of us are experiencing this perfect storm of very large increases in food and fuel prices, which of course impact those countries that are import dependent, but in fact impact everybody because they affect domestic prices directly. So what do we do? How do we deal with this? I mean, you can think of many flaws in the global architecture that have enabled this and which obviously have to be fixed, right? We clearly need a different structure for our international financial institutions. They have proved completely unequal to the task of dealing with either the pandemic or the subsequent crisis. All they do, the latest is the World Bank, which yesterday or day before produced a report showing how it's going to be a terrible debt crisis in the developing world and we are facing major upheavals. Yes, you knew that. So did the IMF. What have you done about it? In other words, they've been sleeping on the job. So the IFIs clearly need to be revamped hugely in terms of not just their voting structure, etc., which is extremely outdated, but in terms of the kinds of conditionalities they require. The conditionalities based on fiscal austerity, based on a false notion of the repayment possibilities, etc., need to be revamped for a completely different set of requirements. They can be climate conditionalities. They can be conditionalities related to meeting these SDGs, the Sustainable Development Goals. And there is a framework, in fact, for what kinds of conditionalities you could ask the IFIs and the multilateral development banks to impose which are not based on a flawed economic model, which has failed continuously over the past 3 decades, but based on current realities and current requirements of the global economy. We could ask for more regulation of capital, regulation of cross-border capital, regulation of domestic capital, regulation of its ability to enter certain areas and the kinds of financing that it engages in. We could ask for more enabling of social protection, also for resilience in terms of the global economic framework. So there are many things in terms of the global architecture that we could and should ask for and demand on the international platform. But let's face it, it's not going to happen, right? The big countries are going to stop it. I mean, advanced economies will not allow any of these changes. We should ask for tax cooperation, for example, which is a low-hanging fruit waiting to be tapped, including taxation of extreme wealth, taxation of large multinationals that get away with almost no tax at the moment. All of these things we can ask for, but we will not get it. So in their absence, what do we do? How do we then generate something for recovery? And I would argue that the time has come for really thinking of unilateral and regional measures, because that is the only way in which you would actually get a response, even in terms of more multilateral moves. That the global powers don't give up their powers unless they're forced to. And they would only be forced to if more and more countries are going in the other direction anyway. Fortunately, that has been slightly assisted by the chaos created by the Ukraine war and by the US attempts at sanctions, which have, in a way, signaled the end of dollar hegemony, because they have sent a very loud and strong signal that no dollar assets anywhere are safe if the US decides it doesn't like you, or if the current US government decides it doesn't like you. Now, that's a very important signal, which I believe will lead to changes in central bank policies across the world, including in many European countries, because that kind of dependence on the political whims of a government in terms of all your international trading, currency, financing, and exchange requirements is something that no country can ultimately live with for very long. So even local capitals in different parts of the world are likely to suggest that developing countries look for alternative trading arrangements, alternative financing arrangements, alternative ways to hold reserves. And I believe these tendencies will get stronger. I think this is a chance for developing countries to think of new routes in which will also thereby enable greater possibilities for domestic industrial policy. They do somehow provide for greater routes for domestic policy. I think there is scope for unilateral taxation measures for multinationals and for wealth. And here I would like to cite the example of a few holdout countries. There are 4 holdout countries in the OECD's tax initiative. It's called the inclusive process, but it's anything but inclusive. The base erosion and profit shifting initiative, which is supposed to allow for multinational taxation, but is actually limiting the powers of developing countries to do their own. 4 holdouts, 2 of whom, Kenya and Nigeria, surprisingly, have already instituted their own unilateral measures, saying we will tax all revenues created in our country based on our formula, which is our share of their global sales, our share of their global assets. And they're doing so. They have already started doing so. I think there's scope for many more countries to do that. I think that these are not big countries in that sense in the global scene. There is scope for many more countries to say we are going to tax wealth, at least the wealth that we can identify, and wherever we can identify it. If it is held in the Cayman Islands or in Jersey and Guernsey in the UK and etc., we can, as long as they are our residents or our citizens, impose taxes on them. There is scope for new rules on cross-border finance and for inflows, for countries to impose them unilaterally. Of course, it's much better if you can do it regionally. So if you can get regional agreements to do this, all the better. There is scope for domestic and regional industrial policy. The African Union is already showing the way in terms of regional sectoral industrial policy for pharmaceutical development in particular, because from the pandemic, they have learned that they can't rely on anyone else. So regional industrial policy, specifically in particular sectors, there is growing scope for that. But obviously, we need significantly increased public investment, first of all, in the care economy, which is not just something you need for welfare, for the requirements of sustainable societies, for the needs of women, but it's also something that's hugely employment generating. And we know that employment generation is one of our big challenges, not just right now, but for the future. And for greening of various sectors. Again, it's hugely employment generating. There's a lot of potential for employment generation, especially in decentralized green energy. It does require major upfront investments. So there are many possibilities for alternative strategies. I do believe different countries have to negotiate them in their own way. And certainly in Latin America, I think you already have examples of countries that are trying and will try more and more in the future. Let us hope we get good results in Colombia. We already have good results in Chile. Let's hope we get good results in Brazil. There are possibilities also in this region for governments to move and perhaps think regionally for many of the directions that I've suggested. But most of all, I think we all have to keep learning from one another in the developing world in terms of what we can achieve, even in this extremely fraught, uncertain, and difficult external environment. And so I think this kind of seminar is ideal for that kind of knowledge. Thank you.
A refreshing talk. Not everything is lost. There is scope for domestic policy, globalization can turn into regionalism, and we need to tackle particular issues in our economies. I think there is a lot of discussion that we can do. But for now, we will move to the next talk, which is by José Romero, Transnational Cooperation in the Mexican Economy. Let me give a presentation of José Romero biography. He's an economist from the UNAM Faculty of Economics, teaches of the Center of Economic Research and Teaching, CIDE, and a doctorate in economics from the University of Austin, Texas. He has served as a professor researcher at the Colegio de México, where he was a director of the Center of Economic Study. He's also a member of the system national level of researchers. He's part of the multiple editorial committees of journals such as Economic Quarter, founding member of the Industrial Development and Growth. His academic production is made up of more than 100 investigations published in magazine, books of own ownership, and book chapters, both national and international. Throughout his academic career, he has taught more than 50 courses at the undergrad and postgraduate, participating in multiple degrees of committee and professional exams. He has been a speaker at more than 100 conferences and seminars at national congress and international. I think these details are enough to present our next speaker. Please go ahead, Pepe.
Thank you, Noemy. I changed the name. It's Prospects for Economic Recovery in Mexico after COVID-19. The possibilities of vigorous economic recovery in Mexico are limited by the economic structure that has been constructed for decades and the international environment that restricts our options. Remembering Sunkel, 1971, development and underdevelopment can be understood as partial but independent structures that make up a single system. The main feature that differentiates these two structures is that the developed countries are largely by its endogenous capacity for growth. The dominant country, and the underdeveloped is the dependent economy. The continue with Sunkel. The neoclassical approach constitutes an inappropriate basis for analysis because of its highly unrealistic and restricted assumptions. One such assumption, particularly harmful to the purpose of our study, is we offer the identification of the concept of economy and a country. This means that countries are regarded as independent economic units that exchange products and capital and international market, which are therefore the international economic relations between nations. Apart from constituting a very partial aspect of international economic relation, this approach fails to apprehend one of the essential characteristics of the modern international economy, that is, composed of significant and growing proportion of transnational conglomerates, which are characterized by operating simultaneously in several nations' markets, thus constituting an international economic system that penetrates and overwhelms national economic system. To this Sunken ventures the hypothesis that underdeveloped, marginality, and dependence are three aspects manifestation of consequence of the general process of evolution of international capitalist system. To understand its essence and manifestation, it is therefore necessary to have a vision of the structure of this system. In the US, we end with Sunkel. In the US, with the process of technology change, globalization, and the role of the dollar as a world currency, a severe process of deindustrialization occurred and income distribution concentration also occurred. In the case of Mexico, since the 1st of December of 1982, with the end of an era of government leading the development process and the initiation of trade and capital liberalization, and the dismantling of the industrial policies constructed during more than 4 decades, the per capita income stalled and the income concentration increased, leaving the majority of the population with diminishing income share and increasing inequality. This process also created a loud minority with income compared to the lower end of the US strata, which defends the status quo and globalization. The previous mentioning opening to foreign trade and capital market was supplemented by signing a myriad of trade agreements and further reduced the capacity of the Mexican government to implement development policies. In terms of free trade agreements, Mexico has multiple self-inflicted limitations. NAFTA, for example, was not a trade agreement, but an investment agreement and a mechanism for protection of foreign intellectual property. As Clinton said at the time, the United States give practically nothing to Mexico in commercial terms, because the maquiladora regime already exists and the bulk of the Mexican export entering through the generalized system of preference. For its part, Mexico had already drastically reduced its tariffs in a process that it began in 1983. The fundamental reason for Mexico forming FTAs was not a commercial, but to give all the guarantees to attract foreign direct investment. The treaty was based on the principle of symmetry between two economies, and the inferior degree of development of the Mexican economy was never recognized. Foreign direct investment was given national treatment, so public policies could not distinguish between domestic and foreign firms, and any export incentives granted to Mexican firms were considered unfair trade policies. Since 1983, but especially from 1984, the entire development strategy was based on attracting foreign investment. It was through foreign direct investment will acquire technology, new business practices, increased formal employment, large exports volumes, and the accelerated growth rate. It was mentioned that with this strategy of total opening to the markets of goods and services supported by foreign investment, there will be a convergence between the living standards of Mexico and the United States. The engine of growth was expected to be the export manufacturing sector. After NAFTA, Mexico has signed another 11 trade agreements to try to make the country more attractive to foreign direct investment. According to the Ministry of Economy, currently we have a network of 12 free trade agreements with 46 countries 32 agreements for the promotion and reciprocal protection of investment with 33 countries and 9 agreements with the framework of Latin American Integration Association. However, this multiplicity of treaties, which although they have increased export mainly to the North American area, the results in terms of growth and productivity has resulted in that per capita income has practically not grown since the last 40 years, and the productivity of manufacturers in Mexico is explained by the accumulation of factors and not by the technology change.
Yes, there we are. Yes.
Okay. This is the GDP divided by population. The top one is the US, the middle one is European Union, and the bottom one is Mexico. And the GDP of the Mexican as percentage of the GDP of the United States is this. In the 1930s was about 30%, and right now it's about 20%. And the next one is the total labor productivity that's stagnant in the recent years, and labor productivity of manufacturing is also very small. Okay. Despite these results, the recipe of wanting to boost growth by signing new treaties persists. The Economy Secretariat is pursuing one FTA with the United Kingdom, another with South Korea. This policy is repeated instead of trying to promote the domestic market through investment in manufacturing. Virtually all scholars of economic growth and productivity agree on the central role that technology advance plays in this process. Empirical data from the second half of the 20th century to the present provide abundant evidence that manufacturing output consistently correlates with fluctuations in the economy of the most important nation of the West, and East Asia. Roderick argues that the country's standard of living does not depend on the volume of trade, but the level of industrialization. The standard of living depends on what happens to the manufacturing sector. If this sector is not dynamic, the rest of the economy cannot be dynamic either. Therefore, it's fundamental to have a country's economic future to have a vibrant, competitive, and very specific national manufacturing sector. The Mexican manufacturing sector is Mexican only in the geographical sense of the term, because in reality it's an appendix of multinational corporations from the US, Europe, and Asia that have an interest in exporting to North America. Since 1983, the Mexican manufacturing sector has been dominated by foreign companies. This situation, which persists today, is serious because these companies have established networks of supplies, design, research, and development centers in their countries, but they have no incentive to move to Mexico, unless when the Mexican government did not impose any kind of commitment to national integration or the obligation to associate with national entrepreneurs, an aspect that could have facilitated the transfer of technology. This explains the low domestic content of exports or the products manufactured in Mexico for the domestic market. This fact also explains the eternal and successful struggle to achieve domestic content targets in value chains. This is Singer. From its origins, development theory warned about the dangers of the specialization of developing countries in exports of fragmented activities of global production process, motivated by international competition between transnational companies from developed countries. For the developing countries, the dominance of these companies is unfortunate for two reasons. Because most of the accumulated effects of investment are transferred from the country where the investment is made, and because it leads developing countries to activities that offer less scope for technical progress and in which fewer internal and external economies are obtained. This factor of dynamic radiation, practically absent in developing countries, are what have revolutionized the societies of developed countries. I almost finished. as we have experienced, Mexico, instead of focusing on economic strategy, on attracting foreign investment and signing international treaties, should concentrate on policy for encouraging domestic investment in manufacturing and creating its innovation system, such as Japan, Korea, Taiwan, etc. Manufacturing is by far the most investment-intensive of all sectors of the economy, and it's because of this intrinsic characteristic that manufacturing has rarely expanded without government support and has stagnated so systematically in the absence of it. Manufacturing requires large amount of investment, while other sectors require considerably less. In addition, primary sector service and construction activities require more shorter periods to recover an investment than manufacturing. With these characteristics, it becomes inevitable that potential investors will constantly move away from the sector, unless government changes its natural state of affairs, giving incentive for manufacturing production to be profitable enterprise. Investment in manufacturing sectors will remain virtually non-existent. Given the lack of support and regulation that hinders them, such as FTA, Mexican entrepreneurs prefer to participate in sectors that are not international tradable. That is, that they are not exposed to international competition. They prefer protected sectors such as finance, telecommunication, mining, commerce, restaurant, etc., or activities that depend on concession or government contractors. As far as possible, they prefer not to participate in manufacturing. Mexico needs, on this time, a geopolitical change and the emergence of new hegemonies to apply policies that were substantial success in East Asia, that is, the development state. For this strategy, we face foreign and local opposition. From the foreign side, any change or policy in the development of Mexican manufacturing sector will face fierce opposition from the US and other countries with transnational corporations in Mexico. From the internal side, there is also an obstacle to this development strategy. According to Sunkel, the international capitalist system will contain an internationalized central nucleus of social sectors of greater or less relative importance in each country. These sectors share a common culture and lifestyle, which is expressed in reading the same books, using the same dress, studying in the same things, reading identical texts, similar organization, family, and social life, furnish their houses in the same style and similar architectural conception of houses and building, and in the design of the suburban space in which they reside. He puts this figure, and I finally put this. This is the GDP of population of Mexico and the United States, and in the right, you'll see in the right graph, you see the percentage of income that gets 1% richer in the United States is about 20%, and the lower 50% receive 50% of the GDP. The lower 50% receive about 12% of GDP. And the next one is the middle one, the middle graph with the points is the GDP per capita. And the top one is what they receive the 10% of the richest of the population, and the lower one is the lowest at 10%. And the same thing for Mexico in the right. So if you compare the richest 10% of the Mexican population, almost it's comparable to it's below the average GDP of the US, and which is the sector of the Mexican economy that identifies with the globalization and the status quo. My last page, and I am finished. To this phenomenon of class segregation pointed out by Sunkel, we have to add for the Mexican and other Latin American countries the racial segregation that goes hand in hand with class segregation. What is needed for the new growth strategy is to reinforce the communication with the vast majority of the Mexican people, to acquire class classification and sense of nationalistic identity, to develop a strategy of national development oriented by the state, which has been proven through history, and especially in East Asia recently, much more effective than the neoliberal Godspell. Thank you very much.
Well, now we have a very nice talk of the problem of concentration of capital and how oligopolies are increasing in our economies linked to foreign capital. It's another thing we have to tackle in our discussion of what to do. However, I want to welcome Esteban Pérez Caldentey, which I just saw in the screen. Are you there, Esteban?
Yes, I'm here.
Good morning.
Good morning. Good morning to everyone.
We are very pleased that you accept to give a talk this morning. The name of Esteban's presentation is Stagflation Risk in Latin America. Let me give a brief summary of Esteban's academic life. He holds a PhD degree from the New School of Social Research, New York, US. Currently, he is the head of the Financing for Development Unit at the Economic Commission of Latin America and the Caribbean, Santiago, Chile. He also has worked at ECLAC sub-regional headquarters in Mexico and Trinidad Tobago. He is a member of the editorial board of Investigación Económica UNAM Mexico and the International Journal of Political Economy, USA, co-editor of Rogue. He is also an editor-in-chief of Palgrave Dictionary of Economics, and we are very pleased that he's a member of the advisory committee of the International Economic Development Associate, and he has been very helpful in setting ideas, Latin American and the Caribbean. Thank you for that, Esteban. He's also the author of the first intellectual biography on Ron Harrod. Please, Esteban, go ahead, 20 minutes, and we hope to have a discussion.
Okay.
The microphone is yours.
Sure. I'm going to share my screen then. Okay, I'm going to talk in English and present in Spanish. Show the slides in Spanish. First of all, I'd like to thank CIDE for the invitation, and it's a pleasure to share this panel with Jayati, Ghosh, and José Romero. I'm going to talk about the risk of stagflation in Latin America, trying to combine two different traditions in two different traditions that heterodox tradition. One is demand tradition, which is summarizing sectorial balances, with this structuralist tradition, which focuses on productive structure. I would like to start with showing two graphs regarding the behavior of inflation in Latin America and at the world level. The first graph, which is in blue, shows the rate of inflation, the evolution of the rate of inflation from 1967 to 2021. And you will see that the rate of inflation starts to decline in Latin America around 1995. And although I'm just showing a graph for the region, this happened to almost all the countries in Latin America, irrespective of their monetary regimes. It was a regional phenomena that is related to a global phenomenon, which is the second graph, the bar graph, which shows that the decline of inflation, rather than being something particular to Latin America or to certain or to the adoption of certain monetary frameworks, it was a global phenomenon. You see East Asia, Europe and Central Asia, Middle East, East Asia, Africa, North America, everything just went down around the same time that it happened in Latin America. And the question is, if the external conditions change and inflation is determined by external conditions, why should we not expect inflation in Latin America? And this is irrespective of the type of monetary policies that you can have. And ultimately, the question that I ask myself is that the problem is not inflation per se, but the problem is the context, the structural context, and also the policy context in which inflation reappears. And this is what I like to focus my presentation on, to talk about the context and to talk about context by focusing on this idea of sectorial balances of the government, private, and rest of the world sectors, and classifying these balances by productive structure. The first stylized fact, when we look at the region, the context, regional level, before we go into structural balances, is a decline, a declining trend in the rate of growth. This is rate of per capita rate of growth in Latin America from the from the 1970s to 2019. The other graph is the volatility, but I'm going to concentrate on the trend. And you see a downward declining trend since 1980, and the COVID merely just aggravated this trend, but this trend was present way before. So there was a trend of, I would say, of stagnation in the rate of growth in Latin America, to which the commodity price boom did not contribute very much, actually. This is a graph that shows that you take a 10-year average and you add 1 year every year, and it shows that to see which events may have had a change in trend, and no event has a change in trend. And if you look at more year-to-year basis, you have something like this, where you have the growth rate here in the table, and the different episodes that can account for the growth trend. And you have during the 1980s, the debt crisis. That's when the rate of growth started to decline trend-wise. Then you have all the financial crisis, and then before COVID happened, you have a giant decline from about 2014 to 2019, where the rate of growth declined from about 6 to 0.9%, and then you have COVID. And the decline in the rate of growth during 2014 to 2019 had nothing to do with financial crisis, nothing to do with balance of payments crisis. It was inherent in the way Latin America functions and the way it's related to the external sector. That is generally my hypothesis. The second stylized fact that you have in Latin America is the growth of indebtedness. This shows the growth of indebtedness for the government sector, external sector, and then it shows the debt service in terms of exports of goods and services, which is around 60% of in Latin America. That is 60% of exports of goods and services goes to pay the debt service. And you'd see first, when you look at the graph, you'd see first a decline in indebtedness, and then from about 2009, 2008, an increase. And this is happens in Latin America to all the debt indicators, but once again, it's not particular to Latin America. As a matter of fact, it happened in all developing regions. So there was some kind of structural change. And this, for me, is the second characteristic of the context in which inflation reappears. Inflation appears not only in a situation of stagnation, and there you have stagflation, but it also appears in a situation of greater external indebtedness. And that's very important when inflation is tied to variations in the nominal exchange rate, because variations in the nominal exchange rate that can cause inflation also cause greater indebtedness and less policy space. And then the third factor that characterizes the context is the increase in inequality. This is a table with a Gini coefficient, and a Gini coefficient augmented by wealth for different periods in Latin America, 1980 to 2006, by productive structure. And this happened all over, independent of the productive structure. And the productive structure I classify by countries that export energy, countries that export agro-industrial products, metal exporters, Central American Isthmus, and other countries that are financially integrated like Brazil, Mexico, and Chile. When you look at the evolution, the sectorial balance and the evolution of demand throughout this context, what you will see is that the main factor behind the growth of demand was not the external sector. It was not the non-financial corporate sector. It was the government sector. The government sector has a negative balance throughout the period from, if you take the period 1990 to 2020, the private sector has in generally a surplus. So they were not increasing demand. And the external sector, whether you measure by the current account or by the balance in goods and services, except for 1920, for obvious reasons, because imports fell, they have, you get a negative balance. So they were actually draining growth and not injecting growth into the economy. When you look at the different components, you ask yourself, well, why do these different sectors behave the way they do? Well, what you see in general in terms of the export sector, and here I'm going to cut to the quick because of the time constraint, you see a graph that shows the rate of growth of labor productivity by region, 1991 to 2018. And you will see that Latin America has the lowest rate of growth of labor productivity among all regions. And that's an important explanation. The other important explanation is obviously the other graph that shows the current account balance and the current account balance adjusted by the terms of trade. And if you adjust by the terms of trade, it is even more negative than obviously with the terms of trade. Now, if you look at the non-financial corporate sector by product structure, it has been generally in surplus throughout the period 1990 to 2020, except for the Central American Isthmus, which was negative. But the rest of the countries, the bigger countries and the medium-sized countries that account for the bulk of the GDP in Latin America, it was basically positive. That was, they were draining sectors, they were not pushing in the economy. And one asks oneself, well, why does this happen? And one of the reasons is that the financial sector has a important financial vulnerability sector. And this is a table taken from some computations by the World Bank. The last line shows the percentage of firms of Latin America that have some type of financial vulnerability. And here, the second row shows about 37% of firms. I've done some calculations for firms that issue bonds in the international financial market and those that do not, and I get a higher figure, but an important number of firms are in a situation of financial vulnerability. This is an indicator that shows the coverage of income relative to the interest that firms have to pay, and generally when it's equal or less than 1, there's a situation of vulnerability. The other thing that happens to the other characteristics of the non-financial corporate sector is that the non-financial corporate sector tends to operate with currency mismatches. And currency mismatches have tended to increase in all developing countries since 2007, including in Latin America. So what you get when you try to combine different graphs is you get something like this, where the dotted line shows the rate of growth of fixed capital formation. You see a clear decline since 2010, the global financial crisis, and the continuous line shows the indebtedness of the non-financial corporate sector. So you get increase indebtedness, but the indebtedness has now gone to finance the fixed investment. It has gone to for other purposes, perhaps because they are so indebted, so they have such high levels of indebtedness that they use the proceeds of the issue of bonds in international markets for precautionary purposes, and thus you get a negative relationship between debt and investment, or because you use it simply for financial purposes, period. The only relative contribution to that aggregate demand has been the government sector, actually, since 2006, 2007, but in general, since the global financial crisis. These are graphs that shows a fiscal stance of different countries, of different productive sector groupings in Latin America. As I said before, you have the hydrocarbon countries that export hydrocarbons, countries that export metals, countries that export industrial products, and countries that are financially integrated. You get the same trend. You get an increase in the fiscal stance, and the fiscal stance here are calculated in the godly tradition, the G relative to relative to taxes over GDP, and then you get a measure and you calculate whether it's greater than 1 or smaller than 1, and here it's greater than 1 throughout starting around 2009. But the problem with the government sector and the increased demand from the government sector and increased incentive to demand from that sector is the low value of the multiplier. Here's a value of the last line shows the value of the multiplier for Latin America and for different groupings according to their productive structure. And generally, it's either between 0.90 and 1. It means very little. And it shows that unless you change, if you think about the multiplier in a Kaleskian terms, like including the wage share and things like that, or the profit share beyond, and the different propensities, and unless you have some sort of change in the productive structure, the value of the multiplier is extremely limited. So in Latin America, when you look at demand, and this explains the stagnation, you look at the external sector, which has not been able to increase demand. Then you look at the non-financial corporate sector, which is in surplus, due, I think, in part, at least since 2010, due to great indebtedness and other factors related to balance sheet vulnerability. And then you look at the government sector, which is not able to boost demand because it's not able to increase expenditure or overall expenditure due to the low value of the multiplier. So what you have here is a stagnating situation in which you impose an increase in inflation, and it gives you this picture of stagflation. And maybe they're from different sort of factors, but they got historically, for some reason, combined. Now, the problem, as I said before, is the context. And the problem with this situation of stagflation is that it happens in a context where countries have liberalized and have become very financial openness and open. And a lot of the countries have some sort of exchange rate regime that has tended to be much more flexible over time. The problem with the exchange rate regimes that are flexible is that they're very correlated to risk. And so when you have a change, for example, in depreciation of the exchange rate that combines with inflation, you have higher risk of the government. And thus the only sector that was able at least to increase demand becomes really restrictive in their policies to improve expenditure. This shows the correlation for Brazil, Chile, Mexico, Peru, Colombia, and I showed this graph over and over again because it seems to me that it's very important because it says a lot about the transmission mechanisms between the rest of the world and Latin America, because you can imagine, for example, the United States decides to increase the rate of interest and you get a depreciation of the exchange rate, and then you get an increase in risk, sovereign risk, and then sovereign risk determines corporate risk, and then also the depreciation of the exchange rate has an effect on the balance sheet of the government. Then he also has a balance sheet of the corporate sector because of their external indebtedness, and there you have the effects of inflation. Some of the conclusions that I'd like to finish with is that the situation of inflation is really something that is added to a process of stagnation that the economy has been registering since the 1980s decade. And I don't think that inflation was tamed in Latin America due to the right type of orthodox policies, but because inflation as a global phenomenon was controlled, maybe by factors related to China and increasing labor force. There are different views, but it's a stylized fact that inflation declined throughout all the world, and it obviously declined in Latin America. In a context of a greater openness, then and within the context that I showed, there's an interesting dynamics between growth and inflation that's quite distinct from other periods. This is not the 70s. This is not the 80s. There are other type of dynamics that can be a byproduct or a cause of inflation, such as what happens when the exchange rate moves. The exchange rate creates inflation, but at the same time, this inflation is accompanied by increasing debt. And thus the increasing debt has effects on investment. And so you have a negative relation between inflation and investment, but it's really the depreciation of the exchange rate and its effect on balance sheet that is causing investment to decline. Therefore, inflation is also associated with a reduction in the fiscal space, and it increases the external financing needs to which the IFIs, like Jayati said before, do not respond. And thus, either you go into reserves or you get more indebtedness to close the gap, and you get some kind of increasing debt dynamics. And throughout these channels, inflation aggravates the trend in the region. And the question finally is what to do. What can monetary and fiscal policy do in such a in this context? And I'm just going to finish with some thoughts on monetary policy and the issue of interest rates. So a lot of governments in Latin America have decided to increase interest rates: Brazil, Colombia, Peru, Chile, Mexico. And you say, well, they shouldn't because it decreases demand. But on the other hand, if it's a problem, if it's an external problem and it's a problem of depreciation and you fear capital flights, then what is there to do? What are the alternatives in a context of financial openness when many countries, because of their free trade agreements, like José Romero pointed, they cannot use capital controls. They are completely tied. We know that the rate of interest is complex because of this issue. It is also complex because it has distributive effects, heterogeneous effects among different sectors. The low rates of interest really benefited the banks. For example, there was an article that came out yesterday in the banking system, and in general, COVID-19 has really increased the profits of the banking system. It has an increase, obviously, in cost because from a supply side, it's part of the cost. And if you're more concentrated, you can increase the cost through a markup even more. And on top of the increase in prices and food. And the most important impact, from my point of view, the main channel, I take that as I agree in the sense with Minsky, that the main factor is demand is through the demand price of capital assets and the demand price of financial assets, the present value. And that really, that's the main effect on the economy and on restriction on aggregate demand. So with these thoughts, I'd like to end my presentation and thank you very much for the invitation.
I would like to thank Esteban Caldente. Now we have the explanation of the great moderation and its linkage to liberalization. Thank you.
Sure.
We'll have about, if Jose Romero allows, and we can ask 5 minutes for the next table and perhaps ask for some questions that people here in the audience, I don't know whether we can have online questions, can pose to the speakers. Please raise your hands. ¿Alguna pregunta? Se puede hacer en español, en inglés, traducimos, ustedes dicen.
Thank you. This question is for Jayati. Do you think it is possible that commitments to reduce carbon emissions take into account inventories based on consumption? I mean, nowadays, international negotiations are made based on territorial inventories, but I don't know if do you think another option? Thank you.
Shall we take another question? Please go ahead. Jayati, may you answer?
Yes, thank you very much for that. And in fact, that's absolutely right, that we should, in fact, be doing this on per capita consumption basis. There are estimates that have been done by the OECD based on final demand, that is consumption plus investment, which is the best way to go. And what that shows is that there is a significant increase in the, if you like, the exported emissions of the North. No surprises there, from US, Europe, Japan, particularly, to China and to some other developing countries from 2000 to 2007. That's the very, very big increase. That's the peak. Thereafter, there has been a slight decrease in these, but it is still it's still a gap. The US is the biggest in terms of the gap, in terms of the exporter of emissions, if you like. Again, no surprises. China is the biggest importer of emissions. A bunch of other developing countries are importing. Latin America, surprisingly, it's more or less in balance. Most of Latin America, because you are also, resource exporters. So resource exporters tend to be, high in terms of both the production and the consumption. But one very interesting thing that has come recently is from the World Inequality Report, work by Luca Chancel and others, which is looking at inside economies per capita carbon emissions by consumption. And that's actually very interesting because it tells us that the top 10% in every region are responsible for the bulk, about half or 40% to half, and their emissions have been increasing over the last decade. So the bottom half of the population in even Europe and North America have shown declining carbon emissions by consumption. The top 10% has shown massive increases in every region. And so the US, the top 10%, it's 72 metric tons per capita. By contrast, the bottom half it's only 4 tons per capita, which is kind of striking. The other striking thing that emerges is that the top 10% of our regions, Latin America, Asia, Eastern, the top 10% has higher emissions than the bottom half of Europe and North America. Sometimes twice, 3 times, 4 times the emissions of the bottom half. So what does that tell us? It tells us we should be doing policies to curb the carbon consumption of the top. That's really what we should be doing. In other words, we should have much more directed policies. Carbon tax is a very, what shall I say? It's not a good tool. It's a sledgehammer to try and catch a mosquito. Because what you're trying to do, what it does is it impacts the poor disproportionately. It's a regressive tax. And let's face it, having a carbon tax is not going to stop Elon Musk having a joyride to the moon. it makes no difference. So you need much more targeted consumption taxes that will impact the carbon emissions of the top 10%.
Thank you, Jayati. Can I ask for other people?
I'm going to ask something to Jayati.
Perfect.
It's some people say that, and with the same topic, that the clean energy it will be enough to substitute oil for a long time, and one alternative is nuclear energy, and there is some some stigma about the nuclear energy. And I just wanted to hear about your thoughts about it.
Can I ask another question for the last round? Isabel, please.
Andreas, yeah.
Perdón.
No, go ahead, Isabel.
Perdón, who else was? I didn't.
No. Very interesting.
Thank you very much. Very interesting presentation. I have a question for Jayati, and I think it's like in the direction for the question from Professor Romero. There are too many possibilities and options for contrasting the financial or the crisis, no, for this pandemic crisis. But the question is, what is the political make on the side for this crisis, no? And do you talking about to the investment, probably the investment direct, the investment in the SDG, no, problems, and probably in this direction is the new Green Deal, no? But the question is, what is the option for the development countries? Because, for example, Mexico doesn't have the technology for this transition, for example, in the energy transition. And I think it may a green dependency for the technology. And this is a problem, no? Because we need this transition, but we don't have the technology. And that is my question.
Okay, let's be brief because it's 12 o'clock. We have another 2 questions. I want to make a question. Please, Carl, go ahead.
I'm Carl from Anáhuac University. It may be rather a slight comment or very small comment with respect to carbon taxation on the one hand, and also maybe a minor question with respect to tax corporation, both directed at you, Jayati. So I was hearing to you the sledgehammer of carbon taxation. I'm a bit not bewildered, but critical on that. Lately, I've been reading a lot on carbon taxation here in Mexico, as to my surprise, largely unknown to the huge chunk of the academic society here. But my impression was always that it is mainly if you reduce fuel taxation, which is quite close to carbon taxation, you have a regressive effect. So you benefit the rich and you do not benefit the poor. So if you tax carbon content, then the opposite should happen, right? So if the rich emit so much, then a carbon taxation should, to some degree, hit them more than the poor. That would be my brief idea. But in any case, a progressive, let's say, fiscal strategy to tackle climate change is, I think it's quite daring, and I would be interested if you know any approaches that are more targeted than that. Of course, a carbon tax, I would locate it more midstream, not so much downstream, right? So it's an industry issue. And the second would be if you could elaborate a little bit on why it is low-hanging fruit to cooperate in on corporate taxation internationally.
Thank you. Chandra, I think you also wanted to.
Just, there's one set of recommendations which are made on the basis of particular problems. For example, if we look at José Romero's presentation on the presence of transnational corporations, the tendency to have concentration of capital, the consequences for trade, for technology, for growth, etc., and distribution. And then we have arguments which have got to do with monetary policy, interest rates in the United States, financial flows across borders, which requires another set of policies. Okay, in fact, it was mentioned that possibly we need to think of capital controls. Now, I'm just thinking, can these be implemented independent of each other? Is there a composite policy which is needed? Can you do industrial policy or policy with respect to transnationals without actually doing something about capital flows? Because you would immediately have capital flight, and you wouldn't be able to push through your policy. So so maybe I'm just asking, is there a minimum bundle which is a prerequisite in which policies and finance play a crucial role for us to even begin the process of moving forward?
Thank you, Chandra. Finally, I want to ask Esteban. Are you there, Esteban?
Esteban, yes, no? Yes, I'm here.
You made a very nice presentation of the downturn for economic growth in the last at least 2 decades or more. Today, with the current situation of COVID, that was a shock in the supply side, it has gone worse. And again, we have all this foreign, which I call geoeconomics or geopolitical inflation, of what's going on. Now, what to do is we need to increase production. The only way to be less dependent. Can we go again to the industrial production model of the easy period to start with these big projects and compete with development, or do we need to impose another strategy? Can we repeat the industrialization process as we knew it? This has been bothering me for quite a while. And now I will give the word Jayati, Pepe, and Esteban. Try to be brief, if not the next table will start to shout.
Yeah, thank you so much, but I'm going to also use this chance to ask Esteban and José Romero both the same question, which is really kind of linked to Chandra's question. Esteban, you're saying, and both of you actually said, that the existence of these FTAs means you can't do capital controls. I'm wondering isn't there a way of swimming around the big fish? Can't you do different kinds of taxation on the capital? Can't you do other ways of dealing with this, along with domestic controls on finance, which are therefore giving national treatment, because you're giving both national and international the same kind of treatment? What I'm saying is that, in a sense, all of the things you're suggesting also imply, including what Noemy said, going back to directed finance at some level. So is there a way of doing the directed finance as part of industrial policy and of inflation control, if you see what I mean? Okay, to respond, thank you. Jose, my problem with nuclear energy is really that we really still do not have any technologically viable way of dealing with the waste. Finally, whatever people may say, we don't know how to deal with the waste. And to me, that's too huge a problem to risk. That I'm only being risk averse for nuclear energy for that reason. Of course, nuclear accidents, all of those things are possible. But my concern is just, how do you deal with the waste? And there is no decent way. The French and everybody else just dump it on, islands and places and so on. And that's not obviously the desirable solution. So, yeah. So, Isabel, okay, first let me just talk about, the carbon tax, Carl. Yeah, lots of people love the carbon tax. Jose Antonio Ocampo loves the carbon tax. I've been having a big discussion with him about this also. Because, the thing about, I have two problems with the carbon tax. One, it's basically something that is suggesting that carbon emitting fuels are priced wrong, that you have to set the price. I mean, Stiglitz is another big advocate of this. Have one global price of carbon. And the fossil fuel generating therefore fossil fuels would be priced at a particular way. Currently, we have a massive system of subsidizing fossil fuels. And in fact, the IMF paper is quite striking, right? 5.9 trillion is what they estimate, not 550 billion. But if you count all the indirect subsidies, 5.9 trillion. And it turns out that they have not even counted some of the subsidies given to financing those original investments. So massive subsidies. Why are we doing this roundabout thing that first we subsidize the fossil fuel production, then we tax the price of carbon? Why? Let's just redirect the subsidies. Redirect subsidies from fossil fuel to green energy. Because coming back to Isabel's issue, but that would be one. But the other thing, carbon tax, the way it's designed or the way it's being thought about, especially in the US, is not midstream. It's absolutely downstream. It's border carbon taxes, which are directly impacting developing countries, saying, oh, you use coal, so we'll put a very high tax, because you're allowed to say how much you think it is. Coal is very bad, we hate coal, you use coal, we will tax you more, So border carbon tax and taxes at, basically designed to impact consumption. That's the way they're being designed at the moment. To me, that's wrong. I'm all for taxing production, but the easiest way of doing that is, first of all, getting rid of the subsidies, which will automatically affect the price, of course, over time as well. So, I would say, therefore, you want to shift incentives, do it by shifting the subsidies away from the fossil fuel to the green stuff. Okay, Isabel, you're absolutely right. We don't have the technology and we don't have the upfront investment money, because all of this stuff, in fact, a lot of the technology is now more widely available, especially for solar, and decentralized solar is also possible, but it requires much more upfront investment. So Africa is in this extraordinary situation where apparently it's really cheap. It's ridiculously cheap, the price, and yet they're not getting the upfront investments. So this is the kind of thing that I'm saying that IFIs should be doing. The MDBs should be financing these, and so what you do is you put a climate conditionality, saying you finance this if it does the following, right? The MDBs, the World Bank, they should really be doing that kind of investment. If clearly the market is not rising to it, and you have to offer them all these subsidies and all that, they don't do it. Let the international financing institutions, which are supposed to be doing these things, let them get into doing these things. Yeah. Okay, thanks.
Thank you very much, Jayati. Please, José.
Yes, thank you for the question. I talk about the commercial policy and the industrial policy, but also since we have a free capital market with the US, the Mexican interest rate is given by the United States. We just have an ad for the risk premium, but it's really, we don't have a monetary policy, independent monetary policy. Just we give that away. And the propensity to import is so high that makes the multiplier very low from government expenditures and private expenditures. So most of the expenditure leaks outside the country. So we also don't have a practically a fiscal policy. So that's why we decide to get the balanced budget and no monetary policy. So we are like a toboggan in the rapids without any control about the economy. We don't have very few degrees of what we can do is it's on education, but education is pretty much in very few people study engineering and those technical stuff, and most of the people study what we did, social science, because we have more opportunities in the government than in the productive sector. And as a consequence of this, the science and technology policy doesn't work because most of the industry is transnational. So what we have to add with our councils on science and technology to provide to those companies that already have their their innovative centers elsewhere. So we have to pretty much start from the scratch and see what we can do with the restrictions that we have. So it's a tough job. I don't know if I answered, but.
Thank you very much, Jose. Last but not least, please, Esteban, go ahead.
Yeah, I'd like to just answer the question about industrialization. I think that definitely you need some type of productive type of policies, because the productive type of policies, I think, they're in part responsible for the low value of the multiplier, and also because I think sort of the functional distribution of income tends to determine the personal distribution of income, and that is tied to the productive structure. I'm not sure that a policy of industrialization would work. And if you look at the past, policy on industrialization faced a lot of issues and problems, and they were pointed out very early by Eklund and Prebisch in the 1950s about the the need for foreign exchange and the income elasticities and all the different problems, the size of the market and so on. And the other issue that I think it's one of the major stumbling blocks to using the state as, let's say, as a linchpin for some type of industrial policy is that the state-owned firms are highly indebted in Latin America. If you look at Pemex, I mean, they have 10% of debt of GDPs, is tied in one firm, and so are others. So you have to think about some type of industrial policy, but I'm not sure that industrialization is the way to go. Regarding the issue of capital controls, yeah, you can think about some type of macroprudential policies, maybe some other type of, but I'm not sure. Capital controls generally are not applied in foreign investors don't like capital controls. Countries have most of their debt is the creditors are private firms and not state-owned firms. So you have to maybe think about some type of macroprudential policies for financial stability. Now, the way macroprudential policies are implemented and the way they are thought out in theory is that basically they respond to some kind of friction in the financial markets and in the ability to get voluntary savings into investment. But so far, I think Latin America has its hands quite tied unless there's some change, I think, at the international level in terms of the provision of financial flows or the provision of some different trade arrangements or measures. Thank you.
Well, I think with this last string, we finish this table. Thank you very much. Thanks to the speakers. Thanks to Esteban. And
thank you.
Move to the next table.
We will have ourselves. Thank you.
So we will ask you, the rest of you that are having some coffee and snacks, to join us for the next round. We will appreciate it. We are a little behind, just 10 minutes away from our time schedule, but I think it was worth the discussion and the relationships and the network we had in between the two tables. So good morning, all of you. Let me thank you briefly. Also, the invitation from CIDE, FLACSO Mexico, and Ideas to be part of this international academic event. And in today's second work table, we will also have very prominent academics who will talk about this post-COVID period from a progressive and global perspective. Although we know that the virus has not gone completely and has not disappeared and is still present among us. We currently been facing the fifth wave in some countries, as is in the case in Mexico, the US, and some countries in Europe, Asia, and Africa. But our experts will explain what will happen in the times to come and find out what are some of the responses from public policy to attack the negative effects that the pandemic deepened by establishing more inequality and more poverty in the world during the past 2 years. First, we will have Chandrasekhar. If you don't mind, we will follow the program as is stated. So we will start with CP Chandrasekhar from Ideas, who will present us post-COVID policy and their implications for international inequality and development advance. CP Chandrasekhar taught and researched at the Center for Economic Studies and Planning, Jawaharlal Nehru University, New Delhi, India, for more than 20 years, but recently joined the University of Massachusetts Amherst. He also served as visiting senior lecturer at the School of Oriental and African Studies, University of London, and has done a lot of consulting at the Bureau of Industrial Costs and Prices in the Ministry of Industry at the Government of India. In consulting, he has served with the host international organizations such as UNDP, ILO, UNTACT, ESCAP, AGB, and ICLAC. He received in 2009 the Malcolm and Dishe High Award, presented annually to a social scientist for his or her contribution to development studies. His area of interest include the role of finance and industry in development and experience with fiscal, financial, and industrial policy reform in developing countries. Besides articles in academic journals, his publications include many authored and co-authored books. So thank you very much, Professor Chandrasekhar. Please, if you would like to start your presentation.
Is it? Yeah. Thank you, Jefferson, and I must also thank CIDE and José Romero for having invited us to join this discussion on an issue, of course, which is of much concern to all of us, and this occupied discussion now for more than a couple of years. We also have the background of the previous session, where I think a range of issues were covered in terms of what the post-COVID scenario is like, and therefore the kind of challenges it poses to development policy. I, in fact, want to take off from a discussion at the end of the last session and really focus on one set of issues, which I'll come to in a minute. But I think that is important, because if we ask ourselves, what do we really mean by a post-COVID recovery? There are, I think, well, among many, there are at least three components to it, even if we ignore for the time being the complications created by the war or the invasion of Ukraine. The first, of course, is the whole idea is, can we, or do we observe at all some kind of a V-shaped recovery from the effects, the fallout, the the sort of economic effects of the COVID pandemic. In terms of it being able, in the context in where you are gradually able to withdraw the kind of lockdowns and sort of constraints set on economic activity in order to be able to prevent the spread of the virus, or not prevent, but at least moderate the spread of the virus. That is actually going to get us back very quickly to where we were before the COVID pandemic began. Are we really in a situation in which, if we look at those GDP figures or employment figures, are we really in a situation in which we have this V-shaped recovery? Are we coming back to where we were? And so, what was done and what needs to be done to ensure that? The second, of course, is to ask the question: is that good enough? Because after all, we know that when the pandemic struck, we still were in a world in which, despite a period of almost, not almost, but a period of a decade, we were in a situation where we hadn't fully recovered from the Great Recession, which was triggered by the global financial crisis of 2008, 2009. So the Great Recession was ostensibly being addressed to a certain extent in the United States, where there appeared to be figures suggesting both on the employment front and the growth front that there was a return to levels or trends which were observed in the period prior to the 2008 crisis. But it was clear that one, you hadn't gone far enough to be able to say that you were back on the same trajectory as you possibly were in the period prior to 2008, in the years, let us say, from about 2002-3 down to about 2007-8. And second, that even to the extent that there appeared to be a recovery prior to COVID, that was losing steam. At the point of time when the pandemic struck, it was becoming clear that the principal instrument which was being used to be able to deal with the Great Recession, which was no more fiscal policy as it was in the years immediately following the 2008 crisis, when government spending in some of the advanced industrial nations picked up or was spiked, that really what we had was a greater or a substantial degree of reliance on what were sort of euphemistically described as unconventional monetary policies, which essentially consisted of a combination of a near zero interest rate regime and in some cases even a negative interest rate regime as far as the lending of the central bank to the banking system was concerned. And the other, of course, was the resort to quantitative easing or large-scale bond buying in order to inject liquidity into the system. That is, you basically had reached a situation where the use of monetary policy as a lever to try and get you back to the global financial crisis growth trajectory was actually losing steam, that you were really not in a position to be able to do that. So that's the second element. It's not merely getting back to before the pandemic. It's basically saying, no, that's not good enough, because before the pandemic, we hadn't resolved what we needed to do to deal with 2008. And then finally, there is the issue that if we take even the period prior to the pandemic, if we take the period, let's say, of the 1990s, 2000s, and subsequently, one of the things which a lot of people commented about, which, for example, was visible in some of the charts or graphs which was put up by Esteban in his presentation, was that he was referring to a trend in terms of what was happening to the rate of growth. But if you looked at that graph, you'd actually see the substantial increase in volatility of growth rates. That basically the system had become extremely vulnerable, that the ability to be able to deal even with minor shocks was actually significantly undermined. So that if you're really trying to assess what really COVID did to the system, you're assessing what COVID did to a system which had become excessively vulnerable to any shock, let alone a shock as intense as COVID. And therefore, a third aspect of a post-COVID recovery must be an attempt to try and deal with this vulnerability, this tendency for a high degree of volatility characteristic of economic activity in these capitalist economies to a far greater extent than before. Now, where did this kind of a larger sort of growth problem, which I think defines the kind of recovery we'd be looking to, just in growth terms, because in any case, growth alone is no indicator of anything. We need employment. We need some degree of engineered redistribution of income in favor of the lower deciles of the population. We need at least a minimum degree of access to nutrition and health and education in poor countries and so on and so forth. But even in this limited sense of the indicator of national income, we basically have this complex set of demands which have been placed on the system. One, we need to recover from any particular shock. In this case, of course, the the pandemic. We need to, at the end of that, ask ourselves, is that good enough, or do we need to do more? Because we might have been on a trajectory which actually was not as good as it was because of a crisis which preceded the particular shock that we're dealing with. And finally, of course, are we doing it in a way in which we are able to reduce vulnerability to shocks as we go along? Because otherwise, it's going to be another war, an invasion of Ukraine by Russia, which seems to be something happening in a corner of Europe, and suddenly that actually completely transforms the global economic scenario, at least in the reading of the international financial institutions. Now, if we ask ourselves the question, why do we have this complex challenge, even on the simple growth front, to address? We're really going back to something which happened in the 1980s. We're going back to a period in which all of this became important because the ability of capitalism, both in the metropolitan centers and in the developing countries, to be able to sustain what it managed to achieve in the period after the Second World War and going up to the 1980s could not be sustained. That the golden age, as it was described by many people, could not be sustained. It was not because of the fact that your transition to neoliberalism was not because of the fact that suddenly a bunch of economists sat down and said, oh no, all this intervention is very bad because we've now discovered what is the best way to address capitalism. It was because of the fact that the earlier regime, in which there was a significant degree of reliance on proactive Keynesian fiscal policy, had run out of steam, that you were not in a position to be able to ensure the kind of characteristics which came to describe what was called the golden age in the period after the Second World War and right up to the late 1970s. And that led, in some sense, to a situation we know where there was a substantial degree of deregulation of finance. Now, the point is, if we look at it, the moment that deregulation of finance began to occur, immediately it became clear that vulnerability was an obvious consequence. I mean, look at Latin America. When was the first debt crisis? We're talking about 1982. We're talking about the early 1980s. I mean, in fact, Mexico gave out the early warning notice system that, listen, that once you allow transnational banks and the transnational financial system to suddenly discover countries to whom they never lent before, because these countries were considered to be too risky. They were politically risky because you could have change in regimes. They were considered economically risky because of the fact that they might not be able to generate the surpluses and the foreign exchange needed to service debt if you actually allowed capital to flow into those countries. And finally, there was the all important foreign exchange risk. The depreciation of currencies tended to be a characteristic of these economies for a long period of time. And therefore, you're actually going to be in a situation where the ability of these countries to be able to service debt, which has to be serviced in foreign exchange through a process of transformation of domestic into foreign currency, is going to be extremely difficult to achieve. So therefore, they didn't lend to these countries. But it was really the liberalization of finance, which not merely saw the burgeoning of finance in the developed industrial countries, but also this large flow of capital into the developing countries. Okay. Now, if you have this characteristic generating vulnerability in developing countries, and subsequently we know we've had multiple crises. We had the Southeast Asian financial crisis, we had the crisis in Russia with the government bonds in Russia, we had the real crisis, we you name it. But this was not only a problem in the developing countries. The first major crisis which paralleled something of the kind that you had in the form of the banking crisis of the 1930s, which preceded the Great Depression, was the banking crisis of the 1980s in the United States, when the thrift industry, when the savings and loans industry actually went into a deep crisis. And so it was not merely Mexico running into a problem, or Latin America running into a problem, or East Asia running into a problem. It was at the metropolitan center itself. It was clear that the deregulation of finance is going to had resulted in a substantial degree of increase in vulnerability, and that increase in vulnerability as time went by basically seemed to point to the fact that that increase in vulnerability was coming in the context of a trend growth path, which was a trend growth path which across the world economy gave you less growth than it did during the period of the golden age, the period after the end of the Second World War going up to the 1980s. Let us recall that if you actually look at the degree of regulation of finance after 1934, after the Glass-Steagall Act was passed in the United States, the country which had the most stringent regulation of finance was the United States. And that lasted till the 1980s, till, Regulation Q, the control over interest rates broke down because the rate of inflation in the United States was higher than the rate of interest. And obviously there was a complete disintermediation in the banking system. So you basically had, in the period of the golden age, you had a highly regulated financial structure. Now, of course, you can say that that's no proof that it's because of regulation of finance that you got the golden age. But what it definitely does prove is that the regulation of finance did not prevent the golden age. That there's nothing which the regulation of finance did which actually undermined the ability of capitalism to sustain what was its best period. So once you remove that regulation of finance, not merely because of cross-border flows to developing countries which were now rediscovered as emerging markets, but also in the metropolitan centers, you saw this high degree of vulnerability. Now, it is not merely the vulnerability, but as I said, that there was this trend decline. And what was this trend decline due to? This trend decline was due to the fact that the rise to dominance of finance, as Mitterrand in France discovered at the same time that the Mexican debt crisis came, is that if you actually, in a world of mobile finance, if you actually try to go in for a proactive fiscal policy in order to increase employment in one country, you basically would have inflation. That inflation would mean that you would end up with a situation where you had a balance of payments problem. The currency would begin to decline, as happened at that time to the French franc. We still were not in the world of the euro. And therefore, he had to withdraw. He had to withdraw from proactive fiscal policy. We basically entered a period in which the rise to dominance of finance constrained the ability of governments, developed and developing, to be able to use fiscal policy as an instrument. However, therefore, what really happened is that the whole discourse changed, and the discourse now was one which said that, oh, we don't need fiscal policy. What we really need is monetary policy. That we're going to rely on monetary policy. But at the time of the 1980s crisis in the developed industrial countries, which is the crisis of inflation, which of course was aggravated by the formation of OPEC and the rise in energy prices at that point of time. Two oil shocks, 73, 74, 78, 80. And, Paul Volcker came and monetary policy basically took the form of severe monetary stringency. But what actually happened is because you were sort of dampening the ability of the system to grow, and because of the fact that this was a period in which the liberalization which accompanied the rise of finance resulted in the relocation of capital of industry to low-cost locations like China or Vietnam or Cambodia or Latin America or Mexico, wherever it may be, you ended up with a situation where very soon you moved from a world in which the principal aim of monetary policy was to control inflation, to target inflation, to one of the period of the great moderation. There was hardly any inflation. So monetary policy became the instrument to try and push growth. Now, if you actually look at that, what it basically did was that it generated a period when, not only because of the fact that the United States had for a long period of time behaved like a government which had no budget constraint. It was exploiting, as Tobin put it, the mint in its backyard. It minted the dollar and it spent it in terms of sending dollars abroad for investment, for economic influence, to finance the Vietnam War, to do all of these things, so that there was this excess liquidity of dollar in any case accumulating in the world system. But despite that, you actually ended up with a situation in which the United States kept injecting liquidity. But to do that, you needed a Federal Reserve which constantly pumped liquidity into the system. So at the time prior to the 2008 financial crisis, when there was no inflation, but everybody said, okay, there is no inflation of goods and services. But look at what is happening in the stock market. Look at what is happening in the real estate market. That we basically are in a world. We basically are in a world in which asset price inflation is a severe problem. So they told Greenspan, please hold back. Because it's true that we don't have inflation in the prices of goods and services, but we have asset price inflation going on. The London Economist, a conservative, magazine, wrote an editorial saying that we need to do something. We need to actually, cut back on this sort of easy easy money policy, because of the fact that this asset price inflation is going to generate a crisis. And what did Greenspan say? Because he was in some sense the god of the new dispensation in which you use monetary policy to try and generate bubbles on which growth rode across the world, but particularly in the developed industrial countries, on the credit bubble. He said, I don't see any bubble here. There's a little bit of froth, but that's nothing to be worried about. Where is the bubble? There's no bubble. So your whole idea was, you used the context of the great moderation, which came as a result of the neoliberal embrace, to rely on monetary policy. And you could rely on monetary policy because the United States, being the country which was the reserve and the home of the reserve currency, could use the Federal Reserve and the fact that it could just mint the dollar to inject liquidity into the system. Now, what was the consequence of that? The consequence of that is, it's amazing. If you actually look at capitalism after the 1990s, if you look at a period of boom, let's say the period from 2003 to 2007, how was the boom generated? It was generated by actually pushing liquidity into the system. You had a 2008-9 financial crisis. What did you do after the financial crisis to address the financial crisis? You injected even more liquidity into the system. The asset base of the Federal Reserve went up from 800 billion to 4.5 trillion between 2009-10 and by the time you got to 12-14. You basically were pumping money into the system by buying up bonds, inflating the asset base of the central bank and putting dollars into the system. And it was a globalized system. You put money into the United States, it went everywhere. And it's not only the United States which did that. But on the other hand, so therefore it's strange. It seemed to be a world where if you wanted growth, you did one thing. And if you wanted to address a crisis, you did the same thing. In the middle of a crisis, in the middle of the boom, you seem to be doing the same thing, which is what? Just pumping liquidity into the system. Now, this has some consequences. People said, oh, this might be good for the developing countries. But supposing we look at this, the figures. If you take at where, as far as the developing countries was concerned, this money went, and I'm just giving you, between, if you start with 2010, I'm giving you the period after the crisis. If you take the total debt stocks of the lower and middle income countries, the total debt stock, external debt stock, that is, it was about 4.3 trillion in 2010. If you get to 2019, which is before the COVID crisis came, you're basically talking about it having gone up to $8.25 trillion, which basically meant that every year there was something like a $432 billion increment in debt in the lower and middle income countries. But did that mean that all these countries were getting all this foreign exchange and they could do what they want and import what they want? No, because if you actually look at it, supposing you take 1 year, 2020, which was the year when peak countries needed this money because of the crisis. Out of the 444 billion, which that year was the increase in the debt stock of developing countries, 206 billion was on account of just one country, China. And China did not need this money. China was sitting on huge reserves, trillions of dollars of reserves. Why did it need no money? Because you had liberalized and the money went where they thought they could make their profits. They went to China. So it's not that this was something which was doing good. It was actually only increasing vulnerability, and that vulnerability began to reflect itself in terms of the inability to be able to sustain without crisis this kind of a growth strategy. Now, the problem with this, of course, and I want to conclude with that, is that if we therefore look at it, in some sense, the supply side push of liquidity in the international system is what global capitalism relies on today, whether it's a period of boom or whether it's a period of crisis. And what that does is it constrains policy space. You can't have fiscal policy which is proactive. You can't have industrial policy because if you try to do something, if you want to have more taxes, there'll be capital flight. People say, no, you can't do that. Tomorrow all the money will flow out of your country and you've got so much of accumulated legacy capital. So you don't have policy space. If you don't have policy space, how could you have a V-shaped recovery? How could you get to a better position than you should have been in before the crisis and so on? And finally, of course, you end up with a situation where the world is characterized by a high degree of vulnerability. So today, what are we really worried about? That the United States, faced with inflation, in a situation in which growth is low, you're in a world of stagflation, has decided that no more can it adopt this policy. It's going to push up interest rates and stop bond buying. And the moment you do this, what's going to happen? You're going to have a crisis because you're drunk on liquidity. The whole system is drunk on liquidity, so that financial markets, which are the biggest beneficiary of this liquidity inflow, might collapse. Stock markets globally might collapse. Bond markets might collapse. And therefore, developing countries are wondering what exactly is going to be the consequence for their exchange rates, for their ability to be able to pay the debt that they've accumulated over a period of time, of the kind that Esteban was talking about. And therefore, I think what I'd like to stress is that if you're talking about a post-COVID policy, or we're talking about a medium-term policy, or a long-term policy of trying and see whether we can overcome backwardness, it has to start in the post-1980s world. It has to start with an inability of developing countries to be able to control finance by urging the international community to allow it to do that in order to create the policy space to make these changes. Thank you.
Thank you very much, Professor Chandrasekhar. There's no doubt about it. Your ideas about how you compare the different crises capitalism has had throughout all this most recent years. How you compare this pandemic crisis with the 2008 and 2009 financial crisis and the previous crisis in the 1980s in East Asia and some countries in Latin America, such as Mexico and Brazil, Russia, and some others, and how the response, the only response, because the economic policy is a kind of it has a kind of a hands tied, because there's no other chance, if I get it right, other than monetary policy right now. So we've been experiencing in this in the last months, as you mentioned, and how the interest rate has been raised in the United States and pretty much in Europe and some other countries. So we will see what happens. So then our second exponent is Charles Abugre, who has taught development management at the Center for Development Studies at Swansea University in the UK, summer courses on gender and macroeconomics at Utah University, and headed United Nations Millennium Campaign as the Africa Regional Director based at UNDP Nairobi, Kenya. He is currently a development consultant and convener of the Foundation for Transformation of Marginal Areas, TAMA, and CEO of SADA, SADA. Charles has been active in the social civility space in Ghana at Pan-African level and globally for decades. Nationally, he has catalyzed, contributed, or co-created several civil society organizations, networks, coalitions, campaigns, including ISODEC, the Tier World Network, the Center for Public Interest Law, the Ghana National Education Campaign Coalition, the Northern Ghana Network for Development, the Alliance for Reproductive Health Rights, CIDE Finance Foundation, and the National Coalition Against the Privatization of Water, among others. Charles will expose us how can lower middle income countries finance their economic recovery and rebuilding in the wake of multiple storms. So please, Charles, go ahead with your presentation.
Let me also thank CIDE for the invitation, but also for the logistical support since we all came here alongside FLACSO. This is my second time in Mexico, but probably my longest. I am looking forward to returning to Mexico. My responsibility as executive director of ideas. I wanted to talk a little bit about probably the vulnerabilities in the most vulnerable continent. And in particular, I highlighted lower middle income countries because they represent arrested development in the concept of the way we understood development as human progress and as transformation of economies. But they are no different from the average African economy, and therefore my comments will be in that context. When COVID hit, there were quite dire predictions as to what was likely to happen to the African continent. It was predicted that a minimum of 3 million people might die, and this was because of the very weak health systems, very weak infrastructure, basically a very poor economy with a very weak capability to adapt to headwinds of such magnitude. That didn't happen for reasons we are still trying to explain. There were very minimal deaths. But what happened was that for the first time in 25 years, Africa's economy generally went into recession. It shrunk by nearly 2%. This follows, anyway, a steady decline and deceleration of growth that has been on and off, but broadly since the mid-2000s. Growth deceleration has followed two main trajectories. One, the dominant one, has been the response to global commodity prices. So the graph that just demonstrates a shorter period of sometime 2006 to the period of the COVID, and it demonstrates two things. One, it demonstrates volatility. Secondly, it demonstrates a trend decline. But there's also a third factor, that the sharpest experience of volatility and decline is low middle income African economies that are 50% of the economy of African countries. 5 or 6 are upper middle income countries. The rest are low income countries. Now, this is significant because being a low middle income country, although per capita income remains very low, is a major aspiration for African countries and reflects some progress from a low income country status to an aspiration towards a higher income country status. So that it suffers the slowest levels of growth, this category of countries, and the greatest vulnerability is an important, and this category of countries also fell sharper than the rest of the countries. But there are the growth trajectory in African economies is more than about it's about commodity dependence, that's for sure, but it's more than about commodity dependence. Can't change it. All right. Okay, so I'll speak without graphs. I can't change it. The first is the second driver of growth and vulnerabilities in African economies is largely the okay. So that's thanks. Can I change from here?
Yeah, you can.
Yeah.
Okay, let me see what happens. Okay, is that me or you? I have to. Okay, let me speak without them. Okay.
He's coming with the
Okay.
The change there. The change there. Oh, fine.
This one here, right? Okay. So I was making the point that Africa's growth trajectory is very much tied up with this is the raw material prices in the global market. This is partly because it's the least structurally transformed. It had less than a decade after colonial independence from colonialism to attempt import substitution. Then after, there were all sorts of US and British and French interventionism that then took over the economy, changed the government, the independence government, and it ran straight into the first debt crisis. And so in less than 15, 20 years for most of them, they went straight into structural adjustment programs. For 20 years, the purpose of structural adjustment was basically to accelerate raw material extraction as a means of generating foreign exchange for paying accumulated debts that arose from the energy crisis of the 1970s and the decline in terms of trade for commodities that happened in the 1970s. And so the economies became very accentuated in natural resource extraction. Many of them are quite very dependent on natural resources. Angola, almost 100% on one commodity. Nigeria, almost 100% on one commodity. Oil. Algeria is the same, almost 100% on one commodity. Mauritania, and so on. If you add 2 or 3 commodities, nearly 2/3 of the economies are dependent on the extraction of raw materials, especially minerals and hydrocarbons, and therefore volatilities in this market and trend declines have a very direct impact on growth prospects, on social development, and all other aspects of the macroeconomy. So, for example, between the periods of 2013 to 2017, when global commodity prices declined, you saw also which became a major bust in the economies in the earlier period between 2008 and 2012, when raw material demand by China led to a boom. Growth also sort of grew. So they're still very much tied to commodities, but it is the commodity dependence has an impact more than on growth. It has an impact on savings and public savings in particular, and so volatility in commodity prices also leads to volatility in public finances. Long periods of decline in commodity prices also leads to a long period of decline in public finances, and that also, in the end, leads to the deterioration of public finances, and together with already very low levels of savings because of the dominance of an informal economy, so it's basically informality in the services sector and commodity extraction also means that the sources for revenues are also very low and very dependent also on natural resource extraction. And with low, sources of, taxation also leads to very low levels of expenditure. And in comparison with other groups of countries, the low middle income countries also have had for a long period the lowest level of public expenditure per GDP. Now, that low level of public expenditure per GDP, partly driven by the low levels of revenue, has led to, for over a long period, again, a renewed expansion in external debt. Now, in the period between 1970 and the debt crisis that led to structural adjustment, the structure of the debt at that time was basically public sector debt from international institutions, bilateral debt. The structure of the debt has completely changed. The level of debt burden has also increased dramatically, so that except for oil exporting countries, the debt service burden of some countries as a share of exports. Some countries, few of the bigger countries, including all of the middle income countries, devote at least 30% of their exports to debt servicing. That leaves basically very little to stabilize the exchange rate, and combined with a decline in the ODA, many of these countries that graduated into low middle income country status, although the structures of their economies remain low income in nature, predominantly commodity dependent, very little manufacturing capability, and very little structural change in many ways, they have been pushed into the private capital market. So from an experience of a decade ago, where only Tunisia had access to Eurobond, private capital markets, we now have at least 20 African countries that borrow heavily from Eurobond on very short-term basis, exceedingly high returns, high levels of interest rate, high yields. And so many of the countries borrow from these expensive sources and recycle them and recycle the loans basically to service existing loans. So in a situation like this, we now have reached a situation where there is a combination of a decline in more long-term affordable sources of finance for investing in structural change and an accentuation of short-term capital. And this short-term capital is increasingly available because they are mortgaged against natural resources. So there's an increased flow of FDI, but that increased flow of FDI goes directly into the acquisition of African assets, which is basically natural resource assets. The other second large flow of FDI is into the acquisition of financial institutions and the penetration of European and American banking institutions into the economy. The last frontier of lack of that is not integrated significantly into the global financial market. So there is a debt distress. Now that debt distress in a situation where there is declining ODA, softer money, we then have a situation in which it is impossible to move forward without one, significant debt relief, and second, creative ways of thinking of how to finance development. There are some good opportunities in the horizon. One of it is that in spite of everything, the growth has rebounded in 2021. Why? Simply a release of pent-up demand from 2020, an increase in access to trade, and some increase in agricultural productivity, which is modest. But the African economic community has an optimistic view of the future. The second is that African countries have done quite a major is in the process of developing major institutions that have the possibility of reorienting the economy, African economies, to a bit more sustainable and structural reform levels. The first is, attached it. The first is the creation of the African Continental Free Trade Area. The intention is to dismantle internal borders and increase intra-African trade from the current 6% of total trade to, in the next 10 years, a minimum of 15 and 20%. That seems to be going well. The second is the development and creation of an African Exim Bank. This is already making a major progress in the mobilization of capital to complement the African Development Bank. It has more flexibility than the African Development Bank, because African Development Bank is basically one of these MDIs that is tied up to the IMF, to the World Bank, and therefore it is focusing on African infrastructure, and did manage to at least mobilize nearly $2 billion during the COVID to support the maintenance of infrastructure. There is in the process the creation of an African monetary fund. This is to try and create trade settlements using African currencies, so to reduce the need to have to borrow externally. But all of these things, there is some openness for domestic in industrial policy. My own country, Ghana, each one of these countries now subsidize domestic industry, are putting up some barriers on imports and so on and so forth to protect. This is a change in attitude and needs to be accentuated. Remittances, which actually is the main source of foreign flows, other than FDI that goes into basically natural resource extraction, have been steady. Inflation generally is low across the continent, meaning that if we can deal with the debt overhang, there is room to increase fiscal expansion and deficit financing for development in the public sector. But there has to be debt relief. Second, there has to be an increase in the allocation of SDRs to these countries to deal with their reserves and stabilize their currencies. And we have to think of alternative ways of development finance. And Africa has to tackle its natural resource rents. The average percentage share of natural resource rent, which is mainly in the form of royalties, is 3%. That basically means that the main source of potential wealth is basically captured by foreign transnational capital. This is the state of capitalism and its penetration on the continent. Thank you.
Thank you very much, Charles, for your presentation. Quite interesting, this overview of what's going on in economic and financial terms in Africa recently, and what we can expect, what we can expect in the short run, and its opportunities for the continent. To end this round of presentation, we will have our highly esteemed Alicia Puyana, as we call her in our seminar of development, and she will expose Mexico a progressive government challenges, reforming the political system, facing the epidemic and its pandemic and social impacts, and palliating inequality and poverty. I will summarize part of his extent and an outstanding professional academic career. She's a PhD in economics from the University of Oxford, professor and researcher at FLACSO Mexico, and has been a visiting professor at the University of Oxford, El Colegio de Mexico, and LSE, London School of Economics. She has worked on the effects of the insertion of Latin America in the globalized economy, among which the dynamic effects of insertion on growth, employment, and inequality stand out. Economic convergence, the application to Mexico of the theory of fragmentation and intra-industrial trade, as well as the concept of horizontal inequality. Dr. Puyana has also studied the effects of the political economy of oil in Mexico and Colombia and Latin America. She's a member of the Advisory Council and Editorial Board of many specialized journals. She's also a member of the board of directors of the International Development Economics Association, IDEAS. She has been a member of Cambridge Energy Research Associate, CIRA, and she belongs to the National System Researcher Level 3. So please, Alicia, with your presentation. Please go ahead with the presentation.
Thank you very much. Thank you. I'm very happy to be here. And thanks for the invitation and the possibility of discussing about the very tricky problem of how to restart the economy. But those are economies in Africa and Asia and elsewhere that were suffering from long-standing stagnation, income concentration, and poverty. I think that it was commented at the beginning of the pandemic that the pandemic is blind, class blind, geographically blind, gender blind, and so, and nothing more far from the reality. As Jayati said, and yesterday as well, we were discussing at FLACSO, the pandemic struck much heavily against women, the poor people, the elderly, and in some countries as well. So how can a government like in Mexico and elsewhere to deal with those problems? The pandemic aggravated the long-standing problems in Latin America. Latin America is well known as the most unequal region in the world, and the pandemic made it even worse. And in Latin America, as Charles as well commented, and Chandra as well, the pandemic came after 30 years in Mexico, 30 years of stagnation, economic stagnation. And it was the effect of the very stringent and radical liberalization of the economy process and the establishment of the structural reforms, one of which very important was the liberalization of the monetary and the financial system, even before than the commercial account. So by the end of very short period of time, Mexican economy was almost fully liberalized. The exchange of goods, the circulation of capital, and the financial system, but no, the labor market. The labor market was deregulated within the country, but was forbidden to, and it is, for migrate to the United States and so on, is very costly and very risky to migrate. Then we have a system very unequal, complete liberalization of factors of production, but labor, which is the abundant resource in Mexico and elsewhere in Latin America. The liberalization imply the liberalization and mercantilization of social services, which were very needed both to both improve the economic performance and confront the pandemic. What happened? Public health, education, social security, and so on were liberalized, market commoditized, which means that to put this public sector services to compete with private providers of social services. And it was especially important and severe in the health system. But after that preamble, I think that it is important to consider some factors that to analyze the scope of the pandemic and the character of the policies implemented by the government. First is the lackluster economic development that was shown for Latin America by Esteban and very well documented by José Romero in relation to Mexico. It was a lackluster economic development. Second, first, the important political factor. The 1st of July, won the presidential elections a candidate with a program, socially oriented program, which make the center of the policy to reduce inequalities, to reduce poverty, and to change some elements of the economic model, but more important, to change quite difficult problems facing the political system, such as corruption. The second, the lackluster economic development, and third, the centrality of the social policies within the government. We sometimes it is discussed that the government is failing, the government failed to control pandemic, it has not improved the economy. The pandemic struck Mexico 1 year after the president took office. But I think that that's my proposition to analyze and to discuss that the program, the government and the Morena movement structure to improve economic performance after 30 years of stagnation, centralized and focalized on social equality. It was and is very good suited for controlling pandemic, especially the effects of pandemic upon the lower income groups. I have not the time to go in detail about the 12 main programs dealing with social equity and social security, but some of them are very important, or some characters are very important. First, that the social policies, or many of those social policies, are universal. So the government abandoned the focalized perspective to social, and doing those programs into the Constitution, which gave these programs some permanent political character that it lacked before. Because before, the social programs were programs, government programs, institutional programs, or institutional projects. And now there are principles on the Constitution with the mandate to respect and changing that is quite difficult because the conformation, the political parties in the government, in the Congress, it makes more difficult to change an element of the Constitution that to delete or change a program, which may be law, but has not the same thing. Amongst those 12 programs, I think that the basic nature of the income, the social policies, the special universal credit for older population, universal scholarships for all students in public academic or in public education institutions, from the primary or the preschool up to the university. It was not before like that. Before like that, only postgraduate students at the university had scholarships. Leaving aside the undergraduate studies. And for me, undergraduate level is the more democratic segment of the education system, because it's the only one that accepts more or less middle class and lower middle class students. It proposed to create 100 universities, popular universities, with special elements, regional universities or city urban university, but focalized on those specialities that are most needed in the localities. I think, was very important. But more important is attending the problems, structural problems of health system. Those programs, as the president called, were meant to reduce the impact of neoliberal system and so on. But okay. Other elements of the neoliberal economic system were not touched, but I am not going to deal with those. Okay. What happened with the public sector, that it put the public sector, health sector on the pressure and to compete with the private providers of the health system, and to reduce the costs for the government of the public system, introduce very risky systems of dealing with the supplies, for instance. Just in time inventories, stocks, which prove and show during the pandemic that those were catastrophic, because they were not vaccines were lacking. They have no ventilators, they didn't have the masks, they didn't have many things because of just in time policies of reducing stocks. Medical resources were subcontracted from supply chains. For instance, exams, laboratory exams, and so on, about 80% were supplied by subcontractors. But Mexico had before that the capacity to do that. It was rural hospitals and intensive units, intensive care units were either reduced or partially or totally closed down. And reduce or scale down the contraction, the hiring of medical personnel, so that the at the beginning of the government, there were about 300 hospitals that were either paralyzed, finished the construction but not inaugurated, finished the construction but not given the medical supplies and so on. It was completely a catastrophe. But more than that, the medical personnel was very under the levels recommended by the World Health Organization. It was a deficit for about 46% in specialists and about 30% of general practitioners. Not to talk about nurses and so on, and paramedics and so on. There was a very heavy, delicate deficit. So the president recently said that he will invite 500 doctors from Cuba, willing to go to the faraway rural poor areas. It provoked a protest from the medical sector. Then the government opened 13,000 places, offered. The response was huge, but very few doctors want to go to poor areas, to those areas to which the Cubans were willing to go. Well, in these circumstances, the confrontation of the pandemic is interesting, because you can see the pandemic was controlled, moving from the very acute pandemic status to rather normal situation in which every year or seasonal. I think that it is an interesting development. If we say that it is a failure, well, let's compare with other countries. So there are about 87% of full coverage in vaccination. That means that there is just, okay, I go. Perhaps it is not 90, perhaps it is not 100, but the 87% fully vaccinated, and many of those with 4 or 3 doses of vaccines. That is the problem, how the vacancies were not offered. Okay. What about the economy? Well, the economy fall very sharply as in 2020. It was a kind of recovery, and here you have some stagnation, I think, because of the international and external situation. You have here the quarterly annualized GDP growth. Again, you can have here the very acute fall, as you show for Africa and Esteban as well. But the recovery is quite good. We are not yet at the pre-COVID situation, but very near. And the compensation, the participation of salaries and work in the primary distribution of income. Again, we can have here and to look at the previous to the pandemic situation. It was here. And now the recovery, but again, in the last months, the decline, but still above the pre-pandemic situation. It's again the GDP. Perdón, entonces yo me equivoqué. Y acá este es el quarterly growth of GDP. And here we have the participation of labor in the primary distribution of income, which is an important recovery. Even that we have here a decline, it is well above the pre, which is one of the main of the proofs or the arguments in favor of the good results of the social policy, especially the increases in the minimum and real wages. And employment. We were talking with Noemy the last some days ago about the recovery of employment. If we have here the unemployment pre-COVID, it is about here. The recovery is quite interesting, but still it can be much more employment, but especially formal employment, because here is a big chunk about the 56% of informal employment. And here is the same compensation of salaries and work by average periods and compensation of GDP, compensation of work as GDP. Variation of employment, the real minimum real wages. You can see that after the 70s, it was a big decline up to almost 2018 when the president took over. And here is the recovery, very interesting, and 2022. Well, I think that productivity is the only one of the factors in economic growth which is not doing well. And I think that some questions have to do with the composition of informal and formal employment, and because informal employment have been increasing very sharply because of the pandemic and the lack of investments, because since the economy is still lackluster, and especially because of the linkages of the industrial production in Mexico with the production, with the industrial demand in the United States, and the situation there is not very clear yet. The demand for the industries that used to export Mexico to United States is depressed. No? Well, I think that is my proposal. My proposal is in the external situation and the internal situation living in Mexico, the government succeeds in responding positively with the same policy elements that were constructed and proposed for rescuing the economy from the neoliberal period, or from the 30 years of lackluster growth, the increase in inequality and the maintenance in poverty. I think that the results are clear, but more clear is that the popularity of the acceptance of the president those days is almost 60-something%. Thank you very much.
You too, very welcome, Alicia, for your great presentation and for reminding us how the new government is trying to tackle the negative effects that neoliberalism has provoked in Mexico in the recent years, and how the policy, the health policy, how the government has faced the effects of the negative the effects of the pandemic, and how the economic response are working on some of the major indicators, as the recovery of the minimum wage, and how the GDP is also on its way to a better shape. We have some minutes for questions, to take some questions, even from the panelists, from the table, to some others of the presentators, or even we can take some question from the public. So who would like to ask? Alicia, please.
Thank you. I would like to ask Chandra, what to do with the dependency of the financial sectors in less developed countries, and how, in order to expand the possibility for the governments to design fiscal policy, to broaden the space of fiscal policy. Are you proposing some kind of the linking of the international financial system? Okay. And for Charles, what are the elements of more positive to deal with the dependency of natural resource exports? Because it is a problem for Latin America. Extractivism is constraining very much the possibilities of growth, equality, and sustainability in the environment, and so on. We are trying to study some possibilities of national productive industrial policies. We have a big project on that, and I would like to discuss it with you and with you too as well. Okay? inviting you to participate.
Charles, would you like to go first, or Professor Chandrasekhar?
Yeah, why don't you, then I'll take it together.
Yeah, the question is for Charles. In the last slide, do you mention the domestic industrial policy? And actually, we have a project about that, no, in Mexico. And I like probably you can share with us a couple of this experience in this report. Thank you.
Okay. Yeah, briefly in response to the question, it's a difficult question, but let's put it this way. Let's see the background. If you actually say that, if we take the period after the 2008 financial crisis, if you look at what happened in terms of the budget of the Federal Reserve alone, and all central banks in developed countries did very similar things. As I said, it grew from something like 800 billion to about 4.5 trillion. And if we take it in the period between 2019 and now, it went up from about 5 billion to about 12 billion. I'm sorry, 5 trillion to about 12 trillion. Now, so obviously, countries decide to do what they think is the right thing for them to do. It's not necessarily right because monetary policy is not resolving their problems necessarily. But the way they are responding is actually to try and infuse large amounts of liquidity into the system to save their banks, to save their corporate houses, and to provide, for political reasons, some degree of transfers to small businesses, to households, and so on and so forth. Like in the United States, you basically got a check in your mail, or you got a transfer into your bank account. Now, if the whole problem is if that was remained confined to those jurisdictions, it's okay. But essentially, what you're saying is that there is a supply side push of capital which has occurred over time from the developed industrial metropolitan centers to the developing countries. And that supply side push of capital at the margin gives you more money, but there is also a retreat. So that if you look at the net flow, many countries are actually not getting positive net flows. They're so heavily indebted that even if they get money today, what they're paying is like Sri Lanka is facing now. And it's a major crisis which is facing because it accumulated all this debt. It just issued sovereign bonds out of sovereign bonds, and there was no due diligence on the basis of those who bought into these bonds. But they have the power to ensure that Sri Lanka will repay, or at least that the IMF will help Sri Lanka repay, or China and India will help Sri Lanka repay, whatever it may be. So now, if besides the fact that this creates that kind of vulnerability, it leads to a situation where you don't have autonomy in terms of being able to generate some domestic policy space for fiscal policy, for industrial policy, etc. What you're in essence saying that, listen, as far as what I can see is that we can't discuss what needs to be done to generate a recovery if you don't have the policy space to be able to do the things needed to generate a recovery. So yes, you have to realize that because of the fact that there are these dominant currencies, which the dominance of which do not come necessarily because of economic competitiveness, and the United States is not an economically competitive country, that you actually are faced with the situation where because of the dominance of the dollar, partly because of military and other reasons, you're a victim of policies they adopt. And so, when Raghuram Rajan was the central bank governor of India, he said, no, these developed countries can't do, or the United States can't adopt these policies and change its mind and decide to raise interest rates as and when it wants. As if the United States is going to listen to you. So you need to be able to put in place controls, because once the money comes in, you're a victim. You can be, you can have a change of government in Greece, which comes on the basis of a particular platform, but it's worried that, there'll be a flight of capital. So they don't do what they were voted to do, or they promised to do when they were voted into power. So unless you have some degree of control, you call it delinking, well, delinking. Not there has to be an ability to be able to create pervasive policy space. Because of legacy, that's going to be difficult now. There will be pain, but unless you make that move and sustain it, you're really not going to be, so we can sit down and discuss what needs to be done for a recovery. But the moment you try and do it, you try and raise tax rates, yeah, you will see a flight of capital. Yeah.
I think, well, okay. Alicia's question and yes, and, they are similar. So I would say there are two sets of broad strategies with extractivism. One is increase the national share of extractive rents. Now, a few countries have succeeded in doing this, mainly Botswana and Tanzania. And it takes a bit of guts to renegotiate extractive contracts or get out, to insist on corporate taxation, and to build a domestic capacity to audit. Now, this is important, the audit, because the corporate tax share, wherever you put the percentage, really depends on what is declared as profit. And that manipulation of the balance sheet is one of the ways in which international transnational companies manipulate and extract rents out of the country. Related to that is an insistence on processing, which is you can't take the raw material out unless there is not the capacity to do so, in which case the contract must involve a process of building capacity to process. Again, Botswana has been the most successful in that, to some extent South Africa. In the case of crude oil, for example, North Africans have been a bit more successful in that, the West Africans not so much. Now, on broad industrial policy varies. So I give an example of my own country in the way in which we are dealing with industrial policy. So I am a member of the National Planning Commission, and so I'm involved in this somewhat. And one of it is the creation of special funds for productive capacity development. An infrastructure fund, which comes from road tolls, road use, energy, which is channeled into a fund that allows for critical infrastructure necessary for industrial development to be invested in. That's a statutory fund, and the government can't touch it. The second fund is a special fund for subsidies, industrial subsidies. And that comes from a share of trade taxes. So a share of trade taxes is channeled into a special fund that provides subsidies in two ways. Direct subsidies for agro-industrial investments. We call them one district, one fund, one factory type project, and an indirect subsidy, which serves as through the central bank as a guarantee fund for subsidized interest rates from the commercial banks. So the central bank also makes a contribution. I think we borrowed this from Nigeria. Central bank makes a contribution, creates a fund from its profits. And in the case of Nigeria, uses it to support investment in the agribusiness and agricultural production. Okay, so I'm sure if we look at each country and the way that they deal with industrial policy, it varies from country to country. What we haven't succeeded in doing is raise the overall tariff levels, import levels, and to increase revenues from trade, as well as introduce export taxation. That's the IMF really fights very hard to stop. But we are still looking at how we do that selectively, especially for natural resource extracted products, so that we reinstitute export taxation for these and channel those resources to funds for investment.
Thank you both for your responses. And I think we can take a couple of more questions. One from Noemy, Levy, and as far as I know, there's Esteban, Pérez also on the line waiting to do some question. So please first, Noemy, go ahead.
Very quick. If I look what happened with the financial capital since the Second World War, well, first of all, the capitalist system is an oligopolistic system that requires capital markets. This comes from the 19th century, and it has been working like that. I think it's a structural feature. The Second World War solution frees financial capitals. And then came the euro market crisis, very easy, that swept away all the regulation of financial capital, almost all. If I see now this financial capital mobility in terms of Mexico and the presence of big corporations, what I find is that they are completely unlinked to domestic capital markets. And I wonder whether there can be some regulation for big corporations, not only to transfer technology, but operate in domestic capital markets. Because we have cried out for Tobin taxes, limit capital mobility, and hasn't happened. I wonder whether these other type of regulations can happen or are feasible. And in terms of raw materials, it's amazing what you say, Charles, about what's happening in Africa. In Latin America, there have been so much difficulty in putting a value added to raw materials. Chile, Peru, Colombia, whatever, Mexico. And there is a big scandal that we're using the petrol to make gasoline, as I think I said yesterday. So how could you manage to do it? Because I think you're also subjected to the same control of big developed countries. This is what amazed me. I hope we could do it.
If you don't mind, we can take Esteban's Pérez question.
Yes, hold on for a second, please. I have two questions for the panelists. The first one relates to the international sort of financial architecture and to the role of credit rating agencies. And the question is, most Latin American countries have, during the COVID, they received short-term capital flows, they increased their debt, and although they manage sort of lower interest rates, they have to pay interest rates for quite some time, for 25, 30 years, some of them. And what do you think is the possibility of having a multilateral credit rating agency as part of the global architecture that would allow Latin American countries to have a more space in terms of receiving financial flows, in terms of accessing liquidity? That's my first question, especially since, for example, I know that, for example, the Federal Reserve really controls domestic, U.S. monetary policy, but also foreign policy through, for example, debt swaps in dollar terms with other countries that hold treasury bills and U.S. treasury bills and the like. And the second question I have is something that we have not mentioned this also in the environmental questions, is the role of development banks, national development banks. I mean, Jayati mentioned the minor role actually of international financial institutions for the global crisis, including multilateral development banks. And I think development banks, perhaps national development banks, could play an important role in channeling liquidity, and also in obtaining liquidity and channeling liquidity towards sort of investment projects and green finance. And I would like to know your opinion on both issues. Thank you very much.
Could I ask a question as well?
Yes, please go ahead.
Thank you. So this is taking off a bit from Noemi's question in terms of the, oh dear, now I've forgotten because I have 3 questions. Let me do the other ones first. One is, in fact, about Charles, this is for you, but I think also for everybody else. I know debt is not such a big issue for Mexico, but it's a huge issue for many, many developing countries. But you can't do the earlier HIPIC style thing anymore, because the public and multilateral debt is only a small part of the total debt. And a significant amount is actually bond financing. So restructuring or debt, any kind of debt resolution is a much more complicated affair, and it also requires legal kinds of changes in the City of London and New York, which is where most of these debt contracts are negotiated. So just in terms of, we can all say, yes, we have to do the restructuring. I think just how we do it is so complicated now that it's worth thinking this through in terms of how it can be done, because it's a different ball game from just the official and bilateral and multilateral debt. Noemi, sorry, will you just remind me what you had mentioned, because it was taking off from your question.
Would it be nice for them to not only transfer technology but also work with domestic managers?
Yes, so this is in fact related to the issue of capital control, that in a sense what you're not anymore necessarily, you have to do much more specific domestic. In other words, say you're doing national treatment. Don't say this is something only designed for foreign capital, but it's kind of similar to the point I was making in the earlier session, that you can do national treatment which would keep you aligned with all your other international obligations. Yeah, so that means you have to regulate domestic capital markets. That's what I'm saying. So the regulation has to be for both. That's my point, that then you can circumscribe this. Oh yes, and in addition, one of the reasons that a lot of African countries were able to extract better royalties, etc., is that they withdrew from ICRA. They withdrew from the dispute resolution system of the World Bank. To my knowledge, 12 African countries have done that. And that dramatically increased their freedom in terms of specifically negotiating mining royalties and imposing specific conditions on foreign investors for mining concessions.
Thank you very much.
So let me take a number of questions that's directed at me. Noemi, I think the last you directed to me was, but how is it possible to require value addition in the context of yes, but also the dominant role of private capital and their political institutions? Very difficult. So it takes a little bit of guts. That's why there are so few who have done it. So Magufuli of Tanzania, but unfortunately he died, and we are struggling with sustaining that. Botswana is a long historical going forward. Nigeria has been successful in some respect, but definitely not in value addition in crude. That's more a domestic institutional problem. So yes, it isn't easy. In the case, Mali tried it, and the government was removed through French intervention. So there are domestic political economy factors linked to the role of foreign capital and their imperial centers. But those define the boundaries of struggle. Credit rating agencies, yes, the African Union and the ECA are attempting an African credit rating agency, the creation. But of course, to the extent that the main source of capital is London bond markets, Euro bond markets, it will still be a certain process of negotiation to have the dominant credit rating agencies pay attention to the regional credit rating agencies, or for private investment funds to take an African credit rating agency seriously. And we see it as necessary as platforms for discussion and debate to create some kind of a level playing field, some mechanism of questioning the basis of credit rating going forward. So, and the second way in which I think they are trying to deal with this is indirect. And this is the attempt to create this liquidity sustainability fund, the use of to raise money from all sorts of sources, including SDR, to use to create a de-risking mechanism for sovereign bonds, for government seeking, selling sovereign bonds. This is still in the process of discussion, and there are various critical ideas around it. But yes, they're seeking different ways to deal with it. On the management of private capital, yes, it has to be very specific, debt, the private debt. Again, there's been some useful initiatives, and we could intervene in that between some collective work between the African Union, the African Development Bank, and the Economic Commission for Africa to start to use the common framework to work to find mechanisms by which the common framework for multilateral and private debt relief can be implemented. One country tried to use it and was penalized, but they're looking for ways to create some kind of mechanism that where there's some dialogue with the representatives of private bond markets that a country requests a mechanism for restructuring must not necessarily be automatically interpreted as a signal for default, and that there are potential benefits on both sides. So to take out some of the egregious nature of the reaction of private capital markets, to attempt to deal with on a case-by-case basis. And this case-by-case basis has become necessary also to be able to engage with China, which is an important player in the African debt market. So there's still a lot to be fixed, I am sure, and that I think some expertise in this area could be very helpful.
Pepe?
Yes, one provocative question is Hirschman, I believe in the 70s, studying the comparative development of East Asia and Latin America, mentioned that what make the difference is that the lack of nationalism sentiment in Latin America that was the agglutinant factor in East Asia. And he somehow explains the difference in development strength in that factor. What do you think about
which factor, Mr.?
what?
Which factor?
The nationalistic element in both regions.
Alicia.
For Charles, it struck me very much, surprised me, the taxation of exports. You mentioned that it was confronted by the International Monetary Fund, but in Argentina, for instance, in the 90s, I think it was, that due to the high prices of wheat and beef, the government put export taxes to prevent the exportations of that. And it provoked a huge demonstrations that almost defeated the government, had to take it back. Something happened the same in Colombia. And so not only that the international organizations, International Monetary Fund and the World Bank opposed that, but the exporters of those which are very strong politically oppose that. Secondly, I think in Latin America, we had, as Noemi mentioned, some decades or more than decades of trying to process raw materials, oil, coffee, milk, whatever. The problem they face is that the tariffs on processed products are much higher than raw materials. How to confront that? For instance, instant coffee, which is general, faces a 35% of tariffs in United States, while just raw coffee, not toasted coffee, entries free, zero. The same is with oil and so on. In cotton, how you handle that to improve to allow the processing and the industrialization of natural resources? I think that consideration of the size of the internal market that will allow that, and the consideration to some of the elements of the Dutch disease. For instance, the revaluation of the national currency because of the cycles of the raw materials, of the natural resources, and the difficulty on that situation to industrialize. Okay.
Yeah. No, I just two quick interventions. First, okay, let me try and pose the issue in the following way. You see, in the old days, the problem of global capital flows was seen as one of recycling capital from surplus earning countries to countries which have deficits in the balance of payments. Okay. So before the oil shocks, before large amount of surpluses accrued to the OPEC countries and got deposited in the World Bank, in the global banks, the recycling problem was how do you, through the development aid network, either bilateral aid or multilateral aid, and through the flow of foreign direct investment, how do you ensure enough capital to flow to countries with deficits so that the global balance of payments will balance? Because we need the balance. Okay. Now, what is the perception there? The perception there is that the deficit in deficit countries was actually a deficit which came because of, let's say, their position in the international economic order, because of the fact that they were commodity exporters and commodity prices fell, whatever it may be, that there were some structural factors which generated deficits. So you have to have some recycling mechanism. So you either do it through the development aid network, and after the oil crisis, the problem became that, we need to recycle, but the money now is not sitting with governments. The money is sitting with the private banking system because the oil producers are putting their surpluses into the private banking system. So it became, how do we have recycling in a situation in which it is the private operators who control? Now, today I'm trying to argue that both in the case of even some of the poorest countries, and of course in the case of the so-called emerging markets, the problem is not recycling in order to be able to finance deficits which come prior to the recycling problem. It is because capital is flowing that deficits are being created. More and more countries are actually allowing their deficits to increase, facilitated by international finance, facilitated by the IMF and the World Bank, which force you to liberalize, and facilitated by the developed industrial country governments. You actually give them money to actually increase their deficits. So you're not recycling. You're actually generating deficits in order to make profit from the flow of finance. Now, in such a situation where there is a supply side push, you either have to have an international mechanism by which you say that, listen, a certain amount of money must come in forms in which I'm able to actually deal with my debt problem. So let's say you need to have SDRs created in larger and larger measures and given to developing countries. So that's one way in which you say that you give, less than 1% rate of interest money to these countries so that they can actually pay back out of it. The second would be to basically say that, listen, you know, you stop this flow to a certain extent by policies in the developed countries, and they're not going to listen to you. And in any case, a lot of it is being pushed by private finance. It's not being pushed by developed country governments. And you're having contracts of the kind which actually you can't even restructure debt which you cannot repay. Okay. So finally, what you're stuck with, you're saying that countries have to find a way of, in some sense, being able to limit the degree to which flow of capital comes and determines their deficit so that they become deficit victims, as it were, of the international financial system. So now, what is the best way? Whether we should actually tell multinational corporations to come and mobilize money from domestic financial markets, we create conditions. No, we can have a discussion on what are the different mechanisms. But this is definitely one in which you're trying to curb the flow of capital, which is creating the deficit rather than having a recycling solution to a prior deficit problem. And that's the way I'll put it. Now, okay, and the other point I just want to make is about public development banks, which was raised by, the problem with public development banks is when the notion of public development banks, which are very important, which have a great role to play, when they were formulated, the whole idea is that you create institutions which have special access to sources of finance at concessional rates so that they can lend to areas which are more risky or which are not in a position to be able to pay market interest rates and borrow, so that therefore they, let's say, the small peasant economy cannot borrow at market interest rates because they would not be able to repay. So you create special funds in order to finance them, and you do it by creating special windows. Money either flows from the government budget or you create a special window of the central bank, which actually says that I will give this development financial institutions this money, plus I will give guarantees. There'll either be central bank guarantees or government guarantees, sovereign guarantees, which allow them to borrow cheaper so that they can lend cheaper. So you actually, where you're talking about a world in which you had a regulated finance, in which you can create specialized financial institutions, which cannot be competed within the areas they're operating because they've got benefits. Liberalization got rid of development financial institutions or changed their nature because you wanted to create a level playing field for private finance. You cannot have these institutions which have special access to concessional credit, for example. Now, in that context, if we want to revive public development banks, we've got to think of certain things. But supposing we take an area like climate finance, now, listen, the developed countries said they'll give 100 billion. When did they say they'll give 100 billion? By they were supposed to have given that by 2020. They still haven't given 100 billion a year. They're saying now we'll give it by 2023. But what is 100 billion? 100 billion is peanuts. If you actually look at the consequences of their occupying the amount of carbon budget that they occupy. So what you have to say is that, okay, let us take the trillions people talk about. Out of this trillions, let us say so many percent has to be public finance. Of that, so many percent has to be concessional finance. And a lot of that has to be routed through public development banks, which have to be given this concessional or even grant finance, because this is reparations payment for having destroyed the environment. And then you tell these public development banks, you use it because that's local voice determining how much goes to adaptation, how much goes to mitigation, what are the projects you're going to lend to. It's not going to be determined by a bunch of people sitting somewhere in Geneva or New York or wherever it may be. You're actually giving voice to local governments to decide which is the best way to use money, which they are rightfully due if you want them to actually spend to deal with climate, because they were not responsible for destroying the climate as a result of carbon emissions over time. Okay, so first let's negotiate how much flows, how much in concessional finance, how much for public, give how much goes to public development banks, and you can use public development banks. They are great institutions. So, but that requires changing the global architecture. Yeah. Yeah. Not that I agree.
Struggle. Do you want to say something? Oh, about Alicia's point, I think she was making them. Okay, one of the biggest difficulties, that the independent African countries confronted trying to replicate import substitution, to borrow from Latin America, was one, the populations were really just too small and too scattered. So the cost, of production and domestic markets was a big constraint. The new possibilities in Africa is that it's a much bigger population and a much larger share of the urban population. So therefore, the costs of distribution of goods, scale of economics, it's much better. So there's a possibility of some import substitution. And secondly, to make it even better, it's our regional trade integration processes. So we are divided into 5 sub-regions on the continent. The ECOWAS region for West Africa, the SADC region for East Africa, and so on. The COMESA region integrating the North African ones and so on. And the trade integration process is in steps. Each sub-region must open their boundaries and create a common tariff. So a common external tariff. That means that you have a bigger domestic market, even bigger domestic market, which are not national boundaries. To make this work, we have another problem, which is infrastructure deficit. And so you have to create regional infrastructure. So regional energy networks, regional roads networks, and those kinds of things. But this is where our difficulty for transformation is, because to do those require long-term concessionary finance. You can't borrow short-term capital and construct a regional road or construct a regional electricity grid or invest in regional electricity generation capability. So this capital mismatch between what is required for the early stages of structural transformation and what is available in the market is one of the things that is keeping these middle income countries stuck where they are. And they can only just keep becoming more and more indebted because they are recycling the debt to paying old debts in order to be borrowed again from short market, the point that Chandru was saying. So there are solutions, but but much of it is political, and there's a need for an international consensus. And the consensus that has emerged that sees development finance, aid, for example, as something not that good. You want to transition away, from concessional finance aid into private capital, which is a mark of progress. It really hurts the African continent because of this mismatch. So the role of the international financial institutions doing the thing that they were set up to do in order to allow for development to happen, basic infrastructure to integrate, is what the continent needs at the moment. But there's no international movement, international consensus. There's no realization that this is a common thing that needs to be done. And so the share of ODA generally in capital flows into Africa is declining.
So thank you very much to all of you for your questions and for your responses. I appreciate it in personal in the name of the CIDE and the institutions that convoke this event. Thank you very much.
Thank you. The Center for Research and Teaching in Economics, thanks very much all speakers and presentators. We have some presence and some knowledge. Maybe Jayati, Noemy, Dr. Romero, please. Picture, yeah.
Many cameras. Many cameras. Yeah. Thank you.
Gracias, perdón.
Oh, thank you.
Another cup. Nice cup. I think Charles. Gracias. Gracias. Thank you. Ahora sí no me pusieron ni.
Muchas gracias.
Tengo eso.
¿Qué sigue?
Sí, ya se rompió la taza.
Bajamos al camión.